the security umbrella that America provides to the rest of the world. And one thing he wrote about what forms countries can take in sharing the burden is that other countries can accept tariffs on their exports to the United States without retaliation, providing revenue to the US Treasury to finance this public goods provision. What is this new era that you think we might be moving into?
Well, I think we're moving into an era of protectionism and high tariffs going forward, and with multiple different justifications. I mean, we've just heard over the last few minutes on this program, multiple different justifications for these tariffs from different members of the administration. It's to subsidize American defense expenditures. It's to reshore manufacturing. It's to raise revenue. It's to get some kind of magical leverage over other countries. And a lot of these are competing in mutually contradictory, self-defeating proposals. I mean, what I think is at the core of this, and has been at the core of Donald Trump's way of viewing the world for a very long time, is he just doesn't like trade. That's just the basis for all of this. So I think we're really having a lot of wishful thinking if we think he's going to reverse himself on a lot of these tariffs. I mean, all of these are justifications to keep going on tariffs and to keep raising these rates and to maybe make a small concession here or there. But we're going to higher tariff territory, and it's going to last for a while.
Alex, does he not like trade? He doesn't like trade deficits.
Well, I don't think he likes trade in general. I think he sees economic exchanges with foreigners as zero sum. So if somebody wins, somebody loses. So you're right. If they were all trade surpluses, then he'd probably like that. But as we know from looking at economics, right, these are just not super meaningful numbers. I mean, you and I have trade deficits with our local grocery stores, but we'd certainly be better off buying from them than growing our own food, right?
When it comes to, you say, the tariff rates coming down, I'm sorry, staying higher, but Scott Bessent saying that's a cap. We can maybe work towards a lower ceiling of that cap. How high do you think they will stay intact?
So that's a huge question. That's an important question. I think we're going to see a lot of fluctuation over the next several months. Some countries it's going to come down a little bit, others it's going to come up. But I would be surprised if the average weighted tariff rate goes below 20%. We're at about 25, 26%, depending how you measure right now. We could be over 100% with China in the very near future if some of these retaliatory threats come to bear. But we're not going to go back to a situation prior, 60 or 70 or 80 days ago. We're not going to go back to that situation, I think, for quite a while.
What's Congress's role in all of this, Alex?
Well, unfortunately, Congress has given all of tariff responsibility essentially to the President of the United States through various laws. The one being used a lot recently is the IEEPA law, the Emergency Economic Powers Act. Congress has basically abdicated its responsibility. Now, under the Constitution, the Congress does have plenary power over trade policy. It could take that back. Unfortunately, since it gave this power to the president, it would have to pass a law and do it with supermajorities to override any presidential veto. So unfortunately, Congress has sidelined itself, and it will be very, very difficult for it to bring that kind of power back. They should try. It's important for economic policy in the United States and security and good sound policy going forward. But the chance of them succeeding is pretty minimal given how they have to overcome a veto to get it.
Alex, what do we do between now and, say, the next month? Do you see freight just being paused? Do you see things freezing up as people just wait to see what the rules of the game might be?
I think that a lot of people are going to hold back because of the uncertainty of the situation, right? I mean, we saw an insane market swing yesterday in the course of a few minutes that was based on a blip and a verbal pause by Kevin Hassett on television. I mean, people are looking for any kind of good sign that these tariffs are going to go away. They're not going to go away. We're going to see some fluctuations. We're going to see some variations in these rates in the next few months, but generally they're going to remain about as high as they are now on average, and I would suspect that they will stay that way for years.
Alex, appreciate your time. Alex Norista at the Cato Institute. If they stay that way for years, imagine what things will look like 12 months from now.
It seems like some of these estimates for the S&P will need to come down, because right now there is a faith that cooler heads will prevail. There is a faith that if this is really that potentially economically damaging, they won't go through with this. And what every policy advisor has said to us is, they will. So here we are.
You've got to look at it across industry to industry. Some industries will be okay. We have the domestic capacity. Places where we don't have domestic capacity, we will obviously really struggle. There will be some industries that can ramp up that capacity quickly, others where we can't. And this is going to play out industry by industry in the coming years. Ultimately, they want to engineer a supply-side response. The key mechanism for that supply-side response in the meantime is price.
At this point, you can't build a factory in 2 days. So how else are you going to deal with the fact that demand could potentially be coming up at the same time that supply is coming down?
Up next on the program, Dan Stuyven of Goldman Sachs warning that oil could drop below $40 a barrel. From New York, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Equity futures on the S&P 500 positive hit by 1.7%. On the Nasdaq 100, a lift as well. Bouncing back from a 3-day losing streak on the Nasdaq, we're higher by 1.5%. With your morning movers, here's Danny Berger. Hey, Danny.
Hey, John. Who said M&A was dead? Not only do we have a little bit of it this morning, it's also cross-border M&A. Not only is it cross-border M&A, It is a European company buying a bit of the U.S. That is Infineon, the German tech company, buying from Marvell Technology their automotive networking business. It's something really crucial for self-driving cars. The price tag on that, $2.5 billion. Analysts are marking that it is an expensive price tag and that it makes sense for Marvell so they can focus in on AI. Those shares up 4.25% this morning. Also some earnings to get through. Walgreens Boots reporting this morning, beating on expectations thanks to cost cuts, thanks to improved healthcare business for them. Those shares up 2.7%, but remember, this is getting a take private in the form of Sycamore Partners for $10 billion. That deal expected to close at the end of this year. So how much this can rally is a little bit capped because how much further will it really go from that purchase price? Finally, rounding things up with Stellantis. Most automakers are moving higher this morning. Stellantis standing out for declining 4%. Not only are they trying to navigate these tariffs because they are so exposed to Europe, they've hired McKinsey looking at selling off Maserati and Alfa Romeo. Also this morning, reports that Italian production has fallen to the lowest in nearly 7 decades. The unions there saying it's not going to get better because not only is it falling demand, it's also the impact from tariffs. John.
Hey, Danny, thank you. Appreciate the update. That company's got much bigger problems than just tariffs and have done for quite a while. And on radar this morning, President Trump rejecting a last-ditch offer from the EU to drop tariffs on all bilateral trade in industrial goods ahead of Wednesday's deadline. Trump saying the offer is not enough to reset the transatlantic trade relationship. Elsewhere, Japan is poised to get priority from the US in tariff negotiations after a productive call between President Trump and the Prime Minister. The Treasury Secretary Scott Bessent saying Japan is an important ally and praising the country for coming to the table quickly. So the EU gets pushed back and Japan gets encouraged.
Japan gets encouraged, and also I think the European Union is going to be looking at Japan. Japan's going to be the litmus test for all these allies with the United States on how to approach negotiations. I also think it's very interesting who is leading the negotiations with Tokyo. It is Secretary Bessent and Jamieson Greer. And Jamieson Greer will be on Capitol Hill today. I think it's really important to watch what he has to say.
He's getting a little bit more power over the last 24 hours, and I don't mean Greer. Greer's been in the mix for a while. Commerce Secretary Howard Lutnick seems to have stepped to the side here, and the Treasury Secretary Scott Bessent seems to be in the mix in a way that he wasn't just last week.
I completely agree, and I think the interview I had with him following the Liberation Day ceremony, he was projecting the fact that, look, I wasn't part of, it felt like he was saying, I was not part of these rates. I don't know why Canada and Mexico are not on this list, but now he's the one that's going to be leading the negotiations for one of the U.S.'s most important allies.
So in the Oval Office yesterday, there was a get-together between the President and the Israeli Prime Minister, and we expected some questions about trade, and then we ended up with this headline: Iran and talks with the United States. Iran confirming those talks to take place this weekend over the country's nuclear program. President Trump saying the talks will be direct and are set to follow weeks of tension over discussions around curbing Iran's nuclear activities.
So President Trump was teasing this out last week. I asked him directly on Air Force One on Thursday. Iran is talking about wanting to have these negotiations, a diplomatic off-ramp with the United States, but they want to use an intermediary. And Trump said, I don't think that's true anymore. I believe that they want to sit directly with us. He says that I think it goes faster. You can understand the other side a lot better. And he doesn't think anymore they want to use intermediaries. And he confirmed it yesterday and said there's going to be a big meeting on Saturday. Iran's foreign minister, though, says those talks are indirect, though, Jonathan. So I think both camps are trying to save face and be able to say that they were either direct in terms of the United States or indirect in terms of Iran. I'm sure maybe we'll get a mixed match of the two.
This could have consequences for the commodity market. Oil prices are ticking higher this morning, following the biggest three-day slump going back to 2021. Goldman's saying that Brent oil could fall further below $40 a barrel in late 26 under extreme outcomes, including a global GDP slowdown and a full unwind of OPEC plus cuts. Dan Stuyven of Goldman Sachs joins us now for more. Dan, good to see you, as always, sir.
Thanks a lot for having me.
A couple of different things going on here, one on the demand side and another on the supply side. I think the demand side story is well understood at this point, at least. Could you share with us the developments on the supply side? What's driving these changes?
Yes, so we have taken down our base case for Brent crude oil prices to $62 per barrel by the end of this year, $55 per barrel by the end of next year, primarily on the back of the GDP downgrades that our economists have made over the last 2 weeks. We now expect global oil demand to grow by only 300 KBD this year, so barely any growth. On the supply side, we have also penciled in some modest increases in OPEC plus supply. with not only a bigger increase in May that they have announced, and we also still assume 2 small final monthly increments in June and July. So more OPEC supply, a lower GDP outlook has led us in the market to revise the outlook for oil prices lower, while a sharp reversal in tariff policy could lead oil prices to realize above our forecast. On that, the risks are still skewed to the downside because of recession risk and the possibility of greater increases in OPEC plus supply.
Last year, it was the year that logic died. Hasn't been resurrected, because I don't really understand why, if demand is falling off a cliff potentially and people are decreasing their expectations for growth, you're seeing OPEC increasing their supply, cutting prices at a time when prices are already going down. What's behind that move?
Yes, I think 2 main drivers of the OPEC decision to increase the size of the May production hike. First of all, I think it's a strategic decision to incentivize better compliance from other partners within the producer group, most notably Kazakhstan and Iraq, but also to discipline non-OPEC supply growth. And I think the market started to shift towards this equilibrium mid last year, when OPEC announced that production would gradually start to come back. The second reason is OPEC has been looking at spot data in the oil market, both demand and inventories, and they still look reasonably tight. However, markets are forward-looking and are very focused on the downside risk to GDP in the months and quarters ahead, even if the spot data are still solid, even if that's the case in commodities, but also at the U.S. economy. The hard data, for instance, initial jobless claims, are still spot, but markets are forward-looking.
Yeah, well, talking about forward-looking, there was this one analyst at Pantheon Macro that came out with this, that recent falls in oil prices and shipping costs will offset about a quarter of the impact of tariffs that will trickle through inflation positive. On the flip side, it will decrease capital investment to such degree in the United States because of the dominance of the oil industry in the U.S. What is the price point at which it really becomes deleterious for the entire U.S. oil industry?
Yeah, so at this point, we think that lower oil prices are still a net positive for U.S. GDP, because the benefits to consumers from higher real income still outweigh the losses from capex in the energy sector. That said, we do think that the average break-even price in TI terms is around $50 per barrel. So if we move down lower, we're starting to sort of be in the center of the distribution of break-even costs, where a lot of producers will be under pressure. And actually in 2015 and 2016, when oil prices dropped to around $30 per barrel, we wrote a piece saying low oil prices are too much of a good thing. And in fact, the sign of the correlation between GDP in the US and oil prices flipped. Low oil prices started to hurt activity on net in US. This time maybe a little bit different. Yes, the shale sector is bigger, but they have become much less price sensitive. They're only reinvesting about 50% of their cash flows back into the business. In 2014, they were borrowing. They were reinvesting 130% of their operating cash flow back into the business.
Right, post-COVID has really changed exactly where they're investing in that capital and using that capital. But what is the break-even price right now?
Average in the US, 50 TI, $55 Brent. But there's a whole distribution, and we're starting to hit price levels where it becomes relevant for more and more producers. And in fact, we now forecast US lower 48 crude supply to edge down. At the start of the year, we and the markets had a higher oil price forecast, and we were looking for increases. At this point, unless prices rebound, we think that U.S. lower 48 crude supply has peaked for the next couple of years at least.
We were just talking about the fact that the United States is going to have these talks with Iran on Saturday. How do you weigh the geopolitical implications in the oil market? Because if a deal is struck, maybe we see more Iranian barrels on the market. But if a deal is not, it's going to be maximum pressure. And that Iranian oil going to China may be taken out.
Yeah. If you do see a deal, I wouldn't expect significant increases in Iranian volumes. We don't believe that sanctions have been a major constraint on Iranian oil export volumes. They have increased by about 1 million barrels per day over the last few years. If you saw a return to maximum pressure, you could see an actual drop in Iranian volumes. All other things equal, that would be positive for oil prices. But I think that OPEC has shown its willingness to very rapidly bring barrels back to the market if the spot fundamentals are tight. And so we don't think that you would see a major net tightening effect on oil prices, because OPEC sits on a lot of spare capacity and is willing to bring those barrels back to the market.
Can we finish on gold?
Yeah, for sure.
Biggest two-day drop on the S&P going back to the pandemic. Gold fell. On Thursday, fell on Friday. What's the relationship between gold and risk assets at the moment?
So we think this is really a great entry point to go long gold. We think that spec positioning has been cleaned up because of all the margin calls following losses on equity portfolios. for selling. We do think that spec positioning has dropped from sort of the top 10% of history a week ago to probably now close to the historical average. So excellent entry point. We do think that in the base case, gold prices rise 10% by year end to 3,300 with a risk skew to the upside. You could, in an extreme scenario, rally to $4,250 per troy ounce by year end if markets become more focused on US policy tail risks.
So you think at some point the relationship between risk and gold reestablish itself in a more traditional way? It becomes a haven asset?
I think if equity volatility were to moderate somewhat, I think the positive impact of heightened uncertainty on gold prices would be reinstored.
Dan, appreciate your time. It's good to see you.
Thank
you, sir. Dan Stuyven there at Goldman Sachs. Finished on gold. Gold's still north of 3K. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Former JP Morgan strategist Marko Kolanovic says that President Trump is close to changing his trade policies due to market pressure. Kolanovic thinks that the Trump put would kick in if the S&P 500 hit around 4,800, saying that the president's body language shows that he believes he's lost the edge in his trade war. Elsewhere, Elon Musk's fortune fell below $300 billion for the first time since joining the Trump administration. Musk lost nearly $4.5 billion in yesterday's trade as Tesla shares extended their losses. Musk, though, to be clear, is still the world's richest person, despite losing nearly $135 billion so far this year. A check on Porsche shares, pairing some of their earlier losses, just down about 0.1% in the German trade. The car maker's China sales plunged 42% in the first quarter. That is the worst quarter in China since 2013. Deliveries in North America, the bright spot, however, rose 37% in the same period. The sustainability of those gains, though, have come into question with new tariffs and potentially rising import costs. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. More from Danny in the next hour. Up next on the program, rejecting a tariff pause.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many countries that are coming to negotiate deals with us, and they're going to be fair deals.
In just a moment, we'll catch up with the chair of the White House Council of Economic Advisors, Stephen Myron, from New York City. This is Bloomberg.
You missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power live every weekday.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Session highs on the S&P up by 2.3%, on the Nasdaq up by 2.2%, on the Russell we bounced back by close to 3%. Under surveillance this morning, rejecting a tariff pause.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many, many countries that are coming to negotiate deals with us, and they're going to be fair deals. And in certain cases, they're going to be paying substantial tariffs. They don't want to be in the hands of the Chinese. And the Chinese have turned out to be really not very good at that. People that are with us, they're with us. But we cannot be taken advantage of any longer.
So here's the latest this morning. President Trump keeping investors on edge. Additional tariffs set to kick in over the next 24 hours. Joining us now to discuss, I'm very pleased to say, the chair of the White House Council of Economic Advisors, Stephen Myron. Mr. Chairman, welcome to the program, sir. A warm welcome to Bloomberg Surveillance. I've got to ask you the #1 question on the lips of a lot of people on Wall Street at the moment. Is this a negotiation or the new rules of the game? How would you frame things for people this morning?
Good morning, and thanks for having me. How I'd frame things is that it could be either. I think the president is famous for his negotiating skills. The president is renowned for pulling deals out of a hat when nobody thought it was even possible. I'd remind everyone that the Phase 1 China deal in 2019 was a fantastic deal for the United States that the president created. It covered intellectual property, it covered market access, it covered purchases of agricultural commodities, it covered currency manipulation, it covered all sorts of things, and it was a fantastic deal. And unfortunately, the Biden administration walked away from it and refused to enforce it, and that was a big loss for America. So the president is famous for being able to create deals when nobody thinks he can, and so that's what it can turn into if other countries come and offer the right things that persuade the president.
Well, let's talk about the right things. So as far as we know, Vietnam came to the table and offered to drop their tariffs to 0. That was rejected. The EU offered to drop tariffs on industrial goods. That's been rejected. What would be the right kind of offer? Are they aware of what the right kind of offer would be?
Right. So I think that a narrow focus on tariff rates is insufficient, because the truth is that the non-tariff barriers pose enormous barriers to trade balancing over the long run. Countries have to open their markets to U.S. exports, and I don't know exactly what combination of details they have to make in an offer. But all I can say is that negotiating is better than not negotiating.
Stephen, the difficulty that people are having at the moment, and you're aware of this, I'm sure, is that they're unclear whether it's about barriers to entry or just the deficit, because they are two different things. Which one is it?
Of course, they're two different things, but they're deeply related and inextricably related. If you reduce your barriers to entry, you open your market to U.S. exports. Of course, the trade deficit will respond to that. I think that there's no question about that.
When you talked about yesterday, I know you gave a speech, you talked about this way of burden sharing and some other measures partners could take to potentially get to a deal. Things like even writing checks to the Treasury. How exactly would that work?
Well, I think there's a variety of ways that could work. For one thing, they could just, sort of simply say, hey, America is providing us with, with a defense umbrella which creates prosperity, which creates peace, which allows us to prosper economically. They could say, hey, America is creating a global trading system backed by this defense umbrella, which again allows us to trade, which creates our prosperity, and we're going to help share the costs of those things. We're gonna send some money to the United States to help it provide those things. I think that would be a fruitful outcome. But again, of course, it depends on what the president decides. The president will negotiate the deals that he thinks are best for America, best for Americans, and I can't get ahead of him on those issues.
You also talked about how partners can invest in and install factories in America, or trading partners. Could China do that?
I think they could, but it remains to be seen whether they'd be willing to. I think China's policy has been to try and sort of steal all the manufacturing market share for themselves, not only from the United States but for many of our trading partners as well. And it seems to me unlikely that China would be willing to make that concession up front. However, I would welcome it.
So China said yesterday they will withdraw, Trump said yesterday, excuse me, that if China does not withdraw the retaliatory tariffs, the U.S. will impose an additional 50%, less than 24 hours, starting tomorrow. Do you expect those additional 50% tariffs to come into play?
I think that depends on the Chinese, and my advice to them would be that they have a lot more to lose than America does. That America holds the leverage, and everybody knows that, and therefore they should seek a détente, and they should offer concessions which would persuade the president to relent.
Uncertainty might be a good negotiating tactic, but it's really bad for business. That's been the message from a lot of corporate executives, and what you're seeing certainly in markets. Are you worried that U.S. companies are going to stop investing, and that could stymie some of the progress that you're hoping to engineer?
Yeah, so the president has been very clear that that what he's engaging in is a long-term improvement in the economic welfare of the United States, and a long-term improvement in putting American workers on fairer ground vis-a-vis the rest of the world. Some temporary uncertainty will come along with the transition and with the imposition of those policies. That's without a question. However, I think it's important to understand that uncertainty doesn't really cause recessions. I don't think that there's been a recession that was caused by people wondering, what's going to happen tomorrow. Uncertainty can delay decisions. For sure, as you're saying, there could be some transfer of investment decisions, some transfer of hiring decisions from one month to another. That's absolutely possible. But there's limits to that, because eventually a firm is going to decide, hey, I really need to add this capacity, or hey, I really need to make a decision about what's going on. And at some point, waiting becomes not worth it. So is there a chance that the uncertainty causes sort of distortions in the month-to-month or quarter-to-quarter macroeconomic data that make one quarter look weaker and another quarter look stronger? Absolutely, that's likely, right? It's not only possible, it's quite likely. But companies can't delay decisions forever. Eventually, they got to pull the trigger, and they got to invest based on their evaluation of the most likely policy landscape in the future. And the president has been very clear about what that policy landscape looks like.
In fairness, though, a lot of people, in particular Wall Street economists, have come out and said actually uncertainty can cause a recession. And we have heard that from a number of different Wall Street firms, for a number of different companies, and frankly, the Small Business Consumer Survey came out this morning and saw the steepest plunge that we've seen going back years. There is a question here about, yes, they have to ultimately make decisions, but when do they start laying people off? At what point are you worried about execution risk at a time where some of the structural changes take a lot longer than some of these policies are taking to implement?
Yeah, well, look, there isn't really any material sign of layoffs in the macroeconomic data, so that's not something that I'm seeing right now at all. And what I would say is, again, to remind people that there are three legs to the stool. One is trade renegotiation. The other two are deregulation and tax reform, and those are still in the pipeline. We're waiting on Congress to extend the president's historic tax cuts from 2017, which will sort of preserve low marginal rates in American workers and firms. But on top of that, what we experienced in Liberation Day was a roughly 13 percentage point rise in the effective tariff rate on all imports, and that's going to create enormous amounts of revenue, hundreds of billions of dollars of revenue that can be used to provide additional tax relief for Americans. And the president has been pretty clear, laying out certain forms of the tax relief, and I think that there's scope to go even further than that. I personally would like to. However, it depends on what Congress works out and negotiates with the president on that. I don't always get, I'm not the president, right? The president is the one who will decide in collaboration with Congress. But I think that using that revenue for additional tax relief would be a fantastic outcome. I think that deregulation is underway, and that the combination of making America more competitive via tariffs with making it easier to build and invest and hire here is a fantastic outcome. And when you look ahead to the future, there's going to be an America that's the best place in the world to do business, because the tariffs make it competitive, deregulation makes it easy, and tax reform makes it efficient. And tax reform keeps more money in people's people's pockets, makes it easier to hire, easier to invest, and those are all great things. And the markets will look forward to that. Markets should be forward-looking, yeah.
You're talking about the entire policy proposal. Markets are forward-looking. They're already pricing in just that, the extension of TCJA. What more can be done on the tax side? Do you think we will get no tax on tip, no tax on Social Security?
Yeah, I think we'll see that. And you know, I can't get ahead of Congress. I can't get ahead of the president, but the president's been clear in calling for those things, and I'm optimistic that we'll get them. And I'm also optimistic that we'll get some form of further tax relief beyond that. What form that takes, you know, will be up to Congress and the president. But I think that it would be a fantastic outcome for American workers if we took money raised by tariffs levied from foreigners and used that to lower taxes on Americans. That would create a more efficient, dynamic, competitive economy that would transition into the president's new golden age.
Stephen, how can it be both? How can it be both a source of revenue to provide tax relief and an option for negotiations?
Well, tariffs raise revenue, and then
I've got
from
that
that
piece
revenue.
of it. Yeah, sure. But you said you can negotiate this.
Oh, because the negotiation. Okay, so yes, so I understand what you're saying. So presumably, if the negotiations lead to materially better trade terms for American firms, then you create a booming economy because there's much more demand for our exports.
And then we take the tax relief back?
Well, then you don't have this additional revenue to pay for that tax relief. But nevertheless, Congress and the president are determined to extend the original tax cuts and provide the additional relief that the president has spoken about.
Okay.
So it's a question of how much further beyond that can you go?
We'll keep struggling to make sense of it. We appreciate your help this morning. Stephen Myron there, the White House Council of Economic Advisors Chair. From New York City, the third hour of Bloomberg Surveillance, up next.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, Anti-Money Laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer, you know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulators said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg.
Listen carefully.
Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising chorus conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
There is not an external pressure catalyst on President Trump right now to pull these tariffs back.
Not only do they cause this uncertainty, but they also raise prices, that you see inflationary impacts from them.
The problem for the president is that a lot of world leaders are not quite sure that they can negotiate with him. They don't want to be embarrassed.
There's still a lot of moving parts to this.
The president's asking the American people for a long leash, and we'll see if the American people give it to him.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Savannah starts right now, 90 minutes out from the opening bell, and your equity market is at session highs, up by close to 2.8% on the S&P 500. On the Nasdaq 100, firmer by 2.6. On the Russell, outperformance up by 3.3. 1 minute after midnight tonight, additional tariffs, 20% on Europe, 24 on Japan, 34 on China, and maybe another 50 still to come. Is it avoidable? Are these the new rules of the game? Or can you negotiate this? The chair of the Council of Economic Advisors, Stephen Myron, with us just moments ago, saying it can be both. And that's what we're struggling to figure out.
People aren't really having a good time trying to make this logical and make sense. So there are two cases here. There's the bear case, which is that the tariffs, as proposed, go on at midnight tonight, and there is some sort of retaliation. The bull case is that everyone will come to their senses and realize that this is potentially really damaging, and there'll be some negotiating on some stance, whether it's the president or whether it's the Federal Reserve. It is hope that ultimately is the trade, and is what we saw briefly in markets, surge markets by $2.5 trillion and then crash it again in the span of 15 minutes.
If you believe in negotiations, what can they offer? So Vietnam's offer to drop their tariffs to zero, rejected. The EU came out and made a smaller offer, said we'll drop all our tariffs on all our industrial goods, rejected. There seems to be more of them just tariffs. More than just tariffs and maybe even larger barriers to entry. But then, even when you go through that, you're told that it's about the deficit. It's just about the deficit. Now, sure, one can inform the other. But at the moment, let's say Vietnam goes to zero. Let's say they drop everything. Let's say they don't manipulate their currency. You're not going to get rid of that deficit with Vietnam. That's not happening.
Well, I love the idea of if you go to a grocery store to get your food, you have a trade deficit with that grocery store. Do you say that you don't want to buy food from it anymore simply because you're going to grow your own food because that deficit is problematic? What deficit are we talking about? There is a fiscal deficit that the United States absolutely needs to deal with, and then there is a trade deficit that is a structural byproduct of the U.S. economy being the biggest in the world and the way that it is set up. If you want to undo that, what are you talking about? And that is the reason why a lot of strategists are trying to grapple with the unknown of what this new world order could look like and just what that could do to the footprint of American businesses.
3-day losing streak on the S&P. We snapped that this morning. We're higher by 2.6%. Coming up this hour, Mira Panda to JP Morgan as markets whipsaw on tariff uncertainty. Patrick Moorhead of More Insights as Apple looks for a way around trade barriers. And Nancy Lazar of Piper Sandler on how the president's levies will impact the economy. We begin this hour with stocks higher following 3 days of losses on the S&P 500. Mira Panda to JP Morgan writing, if tariffs stay in place, we're likely to see recession this year and severely impaired profit growth. Even if tariffs were paused or scrapped, uncertainty scars could run deep. Mira joins us now for more. Mira, good morning.
Good morning.
Let's pick up on that line. Even if they come off, the uncertainty in between, how much damage are we doing right now?
There are some things you can't unsay, and from a tariff perspective, to see how this has played out does create a challenge for businesses and consumers. Consumers can bounce back to some degree, but from a business standpoint, if you think about, well, things will get negotiated, maybe we'll come together with a deal, I want to wait until that deal is signed, sealed, delivered, until I start to think about hiring and CapEx. If I think the tariffs are going to stay on for longer, then I really have to reconsider, how do I think about my structure and my costs and how I operate in this environment. So either way, people are a little bit hamstrung at this point, whether it's a negotiation or a longer-term thing.
We're told that payrolls don't matter. Friday data, forget it, irrelevant. We're told the earnings this week, forget it, irrelevant. What are you putting your hands around to put together an estimate for earnings for the coming 12 months?
You've seen across the street a lot of people wiping out their earnings expectations, considering that perhaps tariffs stay on for the long run. It's so hard to think about where we ground ourselves because all of this is going to continue to engender volatility. When we think about potentially a pop in the markets today, we've seen pops during periods of heavy volatility. You see some of the best days and the worst days paired together because people are trying to make sense of things. And essentially, you have earnings season, which is probably going to look pretty good, especially with the lower dollar, but to your point, mean nothing going forward. We're going to have to hear about guidance and what companies are actually doing. That will help us ground ourselves to some extent. If we think about the economic data, it will broadly be dismissed for another month or so. So that also becomes a challenge. We gear ourselves back to the survey data. When it represented uncertainty, then it wasn't really telling us a whole lot. But now that it's representing, well, where do I go from here? The soonest measure we get of the economic strength, then we have to rely on that to some extent. And then it's rumors and headlines.
We were just speaking with the chairman of the Council of Economic Advisors, Stephen Myron, who said that uncertainty cannot cause recessions alone. Is that true?
I don't think that's true, because if you're in wait-and-see mode, those are the three most dangerous words for the economy. Let's see how this plays out. We're not so sure. And again, that uncertainty and those scars run deep, even if some of these tariffs do come off. And that's the challenge here, because what comes off could easily come back on. It does seem like there is a potential that this is a negotiating position. If you think about the president's favorite word in the dictionary being tariff, he also wrote a book about making deals, so it's really hard for us to guess which way he's leaning here. But we did see deals during the 2018-2019 period. We did see concessions during the first month or so of his presidency, and there are some talks in the works. But what more powerful a negotiating position to be in than to say, I have nothing to lose? I think that's the phase we're in. Most market participants are not expecting tariffs to last longer than a couple of months. If that's not the case, though, there's more downside ahead.
It's a very difficult moment, especially because paralysis begets this question of what haven can you really invest in? And that was really highlighted yesterday when 30-year Treasury yields surged the most going back to 2020. At what point does that really raise concerns about the haven status of U.S. Treasuries?
Part of it, too, is the fact that there's this tug of war when we think about yields between slower growth, higher inflation. And I think yesterday's move was a reminder that inflation is still potentially a concern. I mean, if you do get deals across the board, but the Fed were to cut before that, then that puts them in a very tricky position, and perhaps a reason why they may shy away from some of these emergency cuts that people have been talking about, because if all of a sudden a deal has been made, everything is undone, then they're still dealing with inflation at a stubborn base. So there is that fight between, do we see a recession versus do we see a deal and everything goes away? And we're starting to hear more conversations about debt and deficit, some of this reconciliation bill, and it does feel like the administration is tying itself in knots a little bit, because tariffs are pretty regressive. They're looking to pay for tax cuts that are progressive, but then also talking about tax cuts and a higher tax bracket. So you're starting to see that the cohesion, as was pointed out in the last interview, thinking about negotiating versus revenue raising, the cohesion in the overall strategy is really hard for us as investors to think through.
I keep seeing everyone overly focused on the cycle and not enough focus on the system. The Stephen Myron piece that was out yesterday, the address to the Hudson Institute, I would encourage everyone to read. In it, he talks about the financial dominance of America coming at a cost. And he says, while it is true that demand for dollars has kept our borrowing rates low, it has also kept currency markets distorted. Are you thinking about how a structural shift in the system would take away a structural bid for dollar-denominated assets and what that might mean for the kind of multiple that we should put on equities, what it might mean for borrowing costs for the Treasury, those kind of changes?
It would be a total reordering, and I think we're still grappling with what those types of changes would be. But we have long said that when we think about different BRICS countries coming together, or different other countries saying we're going to have a competing currency, or we're going to have a competing system, or digital assets, digital currencies,
what we've always said is the biggest threat to the U.S. dollar is what we're doing domestically, how we're thinking about debt and deficits, how we're thinking about managing in the long run, because we don't want to get too complacent about that reserve currency status. Now, look, the dollar underpins most financial transactions, cross-border payments. It is so entrenched in the system that we are in, so it would take a very long time to erode the power of the dollar, but nonetheless, you can start to see some of this on the margins. And I think a big example of that is the fact that we're seeing a lower dollar at a time where there is fear around a U.S. recession, which is unusual.
You know, I want to build on what John was talking about, because it is interesting when you read the actual economics underpinnings of some of what's going on and some of what's being posited. It actually does go completely against the trend that we have seen in markets for the past some 50 years. I'm just wondering, even if it doesn't all come to fruition, even if you can't take it completely literally on its face, doesn't it make you want to go elsewhere anyway, just because the source of volatility is the United States right now?
There are some things you can't unsay, and that is really, again, the big challenge with all of this, no matter what happens. And we are seeing that. It was supposed to be the year where growth continued to outperform value, U.S. continued to outperform international, duration underperformed, and yet we've seen a flip of most of that. And we've seen within international markets that they're outperforming the U.S. by almost double digits and had been positive up until very recently, because even though they're going to take on a lot of these tariffs, they're also acting in a forward-thinking way of how do we reduce some of this reliance on the U.S. when we think about defense spending, innovation, technology, just a greater attitude of self-reliance. And you're also seeing that, look, some people are saying we're going to play ball a little bit. When we think about international investing, some of the areas that could look a little bit more interesting than others, areas like India, where the negotiations are at play, areas like Latin America, where you're not seeing as much of an impact from higher tariff rates yet. And maybe there's a little bit more of a gearing towards China. So we do continue to look at some of the relative advantages across the market here. Again, value versus growth outperforming by 10 percentage points year to date. But certainly overall, it's a really tough market. We don't want to get too cute. We do want to rely on the sensible diversification that we've maintained, because a lot of those unloved areas are actually what are protecting portfolios right now.
Mira, it's good to see you. Thanks for dropping by. Mira Pandit there of JP Morgan Asset Management. Equities session highs up by close to 3% on the S&P 500. The dance continues. Is it a set of negotiations, or are these the new rules of the game? And the pendulum keeps swinging between one and the other. Over the weekend, it was these are the rules of the game. And then Monday, it became these are negotiations, and that continues this Tuesday morning.
And frankly, you asked that to Stephen Myron, and he said, you know, it could be both, it could be either. You know, it's the president. And so we're not getting a clear answer by design. It seems as though this is a feature, not a bug, when it comes to the differing opinions and sort of a cat's in the bag approach where you've got a lot of animosity or discussion among different people in the council. It just makes it very difficult for investors and very difficult for companies.
As the pendulum swings, that does damage to the economy. Still working out if it's one or the other. That uncertainty starts to hurt. That uncertainty comes up in the sentiment surveys. Mira was talking about that. The reality of where the policy is now comes up in the sentiment surveys, and that shapes action in the months and quarters to come.
And we have to also add to that, we already have seen the 10% baseline tariff implemented. And tonight at midnight, it isn't just uncertainty. There will be certainty of tariffs that go into effect pretty much across the board that would set the tariff rate of the United States at a level that it has not seen since the early 1900s. So there is uncertainty, but there also is action, and people are responding to that.
Equities are up this morning. Session highs up by 2.9% on the S&P. With an update on stories elsewhere with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump is set to sign an executive order expanding mining and the use of coal in America. The aim is to power data centers and revive the declining U.S. fossil fuel industry. The order directs the federal government to take steps to reinvigorate coal and accelerate the export of U.S. coal and related tech. ECB Governing Council member Gedimin Nishinkis says that the central bank should cut rates at next week's meeting due to the impact of President Trump's tariffs. French banking giant SocGen also called for a 50 basis point cut next week and extra cuts to follow in June and July. Harvard plans to borrow $750 million from Wall Street as federal funds come under threat from the Trump administration. Proceeds will be used for general corporate purposes. Bond documents show Goldman Sachs as the sole book runner on the transaction. The administration has already frozen funding for Columbia and Princeton University. That's your Bloomberg Brief. John.
Danny, thank you. Appreciate it. Up next on the program, the Morning Calls Plus, Patrick Moorhead of More Insights as Apple looks for a way around trade barriers. That conversation just around the corner. Equities at session highs. You're opening about 1 hour and 16 minutes away. The S&P up by 2.8%.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The opening about 1 hour and 14 minutes away. Equities higher. Near session highs up 2.6% on the S&P. On the Nasdaq 100 up by 2.5. On a Russell up by 3. That's the price action. Let's get you some morning calls. First up, JP Morgan upgrading Levi Strauss to overweight, noting stronger pricing power that should offset tariff headwinds. That stock is bouncing this morning by close to 13%. Your second call from Goldman, upgrading Eli Lilly to buy, citing a compelling entry point and predicting the company can maintain its pole position as sector leader. The stock is up by 3%. And your third and final call from Morgan Stanley, downgrading HP Enterprise to equal weight, saying thinner margin structure provides less buffer against tariff impacts. That stock just about positive this morning by 0.9%. Let's stick with tech. The Wall Street Journal reporting Apple is planning to source more iPhones from India to the US to offset the cost of China tariffs, a short-term stopgap as the tech giant looks to win a tariff exemption from the White House. Joining us now is Patrick Moorhead of More Insights. Patrick, welcome back to the program, sir. Are you operating with the assumption that they can get that exemption?
I am currently not working under that, and I look back at history where Apple has been exempt a few different times. China made some commitments on trade balances back on Trump 1.0. I just don't see it happening at this point, because if Apple gets a reprieve, why not HP? Why not Dell for PCs? Why not Samsung for smartphones, where they have invested hundreds of billions of dollars just in semiconductors here?
Patrick, this goes in several phases, and to your point, the list would go on and on. The names would keep coming. For Apple, the first phase seems to be people rush into the store and get iPhones at a price they're at now. What's the next phase after that? What do things look like for the company?
Well, it's really a long road ahead. China alone had to import workers from Malaysia. There have been reports that I think if you back into the numbers, that it requires over 1 million workers in China to be able to put together iPhones and iPads. And you can't just replicate that overnight in any country, including India. Let's say 10% max can be moved over within 12 months. You're still staring down the barrel at up to 104% tariffs in China. Again, it changes day to day, but at least a 52% plus a tariff. And even in India, right, you have up to a 37% tariff. Now, I do believe that if deals were made, India would be at the front of the line, but unfortunately, we haven't seen any discussion on India, right? We've heard about Japan, we've heard about Israel, we've heard about Vietnam, but nothing about India. So what's better, 104% or 37%? It's 37%, but Apple cannot move quickly enough. It could take 5 years if they wanted to move most of their manufacturing anywhere else in the world.
Patrick, Apple has lost about $640 billion of market capitalization since end of day on April 2nd. That is about 19% of its value. How much more downside do you see ahead if you don't get some sort of carve out from the tariffs that have been announced?
I mean, I don't want to be too dramatic here, but if you're more than doubling the price of an iPhone in a worst case scenario, the stock value could be cut in half. People don't believe that. Otherwise, they would be trading on that, and they're looking for some type of reprieve. But you have to factor in that possibility that China is the #1 negotiating point for the entire administration. And I have a thesis that says it's really only about China, right? It's building a blockade of partners who can take on China, and they will be the last one to negotiate out there. The other part, which I've heard a couple of your guests talk about, is this fear of recession. So Apple gets hit with the double whammy. They get hit with the Chinese manufacturing hit up to 104%, and then they get hit with a potential recession risk. And if you want to put a trifecta in there of increased prices, it is a very gloomy short-term view on Apple that investors so far aren't incorporating.
Patrick, is Apple uniquely positioned in a poor spot, given the fact that they are kind of hamstrung with production and, frankly, also selling into China at the same time that they are a consumer-facing tech company with the iPhone? Are they uniquely in a bad position relative to the other large tech companies?
They're very unique, and we've segmented our list into most at risk, potentially at risk, and least at risk. And they are at the most at-risk company related to China for the very reasons that we've outlined on the show today with the adder that you just laid out there, that the Chinese consumers have a voracious appetite for Apple products, and they get hit on the reflexive tariffs from China, and they get hit on the tariffs coming into the United States. So somewhat free trade for Apple is limited to Latin America and Europe at this point.
Patrick, I'm pleased that you separated tariffs and the cyclical downturn that we might expect, and the two headwinds for certain companies. Something I think about from time to time, and I'd love your input on, is whether these companies in their current form have ever really been tested by a cyclical downturn here in the United States. And I don't think the pandemic counts, because we had so much stimulus flushed into the system. How do these companies respond to a cyclical downturn? Because for years, people said, keep buying, it's a secular growth theme. Keep buying, it's a secular growth theme. How do these companies stand up to a cyclical downturn here in America?
Yeah, I'm glad you separated out the pandemic, because it was a very different type of scenario, but we haven't seen a full-on recession since 2008 here in the United States. And I would expect the same gameplay to happen, where we would have massive layoffs, prices would go down, interest rates would go down to stimulate the economy. I think we would see probably at least a point reduction once we're knee-deep in a recession to stimulate it. But the challenge here, though, is, again, we're trying to figure out what the administration actually wants. Do they want a systemic change, or do they just want a better deal? You can't build a complex factory in the United States for 1, maybe 2 years at best, and then you've run out of people to actually run those factories. We're already at very low levels of unemployment, and workers just in the United States just don't want to do this type of activity. You would see likely a lot of hugging and kissing between the United States and Mexico, right? Mexico is the next best alternative to these very highly tariffed countries to be able to lower the overall cost. If you look at the wages between Mexico and, let's say, Southeast China, they're still twice as much, but you're still looking at around $5 per hour. So that's the way I expect this to play out. A lot of doom and gloom, a lot of layoffs, and probably a down economic environment that we haven't seen in 25 years.
We hope to avoid it, but that's your base case at the moment. Patrick, thank you, sir. Patrick Moorhead of More Insights. Appreciate your time. It takes a long time to engineer that supply-side response. Higher prices are a key feature of engineering that supply-side response. In the meantime, though, who's going to build that factory right now when you are muddling the message around Washington, D.C., saying this might be a negotiation, these might be new rules of the game? I think a lot of people might wait.
How many times have we heard this from Mike Wirth of Chevron? The long time that it takes to make investments and that predictability of policy is the most important thing that they need for that long-term type of plan.
It certainly goes beyond the term of this presidency as well, when the rules could change again, and this is another issue for everyone. On the S&P 500, up by 2.5%. Up next on the program, Nancy Lazare of Piper Sandler, Martin Orton of Empower. From New York, this is Bloomberg.
The countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Key
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
The open about 60 minutes out. Equities near session highs, up 2.6% on the S&P 500. On the Nasdaq, up by 2.5%. Also on the Russell, the small caps up by 3. 1 hour away from that cash open with your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. Kicking it off with the biggest mover to the upside for the S&P 500 pre-market. That is Humana, the health insurance giant, up 16.2%. This comes from a decision after the close yesterday from the Trump administration to significantly increase the Medicare payouts for private insurers, $25 billion. That exceeds even the most optimistic of estimates. So Humana, CVS, United Health, all those are higher in the pre-market. Broadcom also higher. That is up 5.75% this morning. A $10 billion buyback that they are putting into this market. Remarkable for a company that is highly exposed to international supply chains in the midst of tariffs. Even so, they are doing this vote of confidence after their stock slid some 30% year to date, so a whole lot cheaper to buy things back. Levi's also reporting earnings. This is an interesting one because it's really the first retailer to do so in the face of tariffs. And people have been looking, what will they say about tariffs? What does the C-suite say? Well, you can see by the reaction, they had not too negative comments, 13% rise pre-market. They maintained their outlook for 2025, but here's the rub. They said that assumes that there's no deterioration in the macro environment, in consumers, in supply chains. They admitted that they're having a hard time analyzing just the impact of tariffs, and they have now assembled a task force to try to understand that. John.
Danny, do you think in the boardroom when they came up with this idea, do you think they realized how effective it might be, looking at that gain in that stock?
Well, look, it worked because I think the assumption was that they would come out and say things are looking really dire for us, but they didn't do that. In fact, John, they said that this quarter, tariffs have a minimal impact. It's gotten people excited, but what happens when they actually need to incorporate the outlook?
Danny, thank you. Their stock is up by 13%. Bramo seen. Everyone looks at that and they're like, playbook, let's go. So they come out on the calls over the next several weeks and months and say, we assume no change to the macro outlook off the back of the policy changes down in Washington.
You have to wonder how much collectively Wall Street looks at that and says, whew, that sounds great, cool. Or how much people say, what are we talking about here? I can imagine, based on the rhetoric that we've heard from a number of executives, whether it's JP Morgan's Jamie Dimon, Ken Griffin of Citadel, or frankly, Larry Fink of BlackRock, telling Eric Schatzker of Bloomberg at the Economics Club yesterday that most CEOs he speaks to believe that we are in a recession currently. How do you square that?
Equities right now, session highs. That's how we're squaring it at the moment. Busy week ahead. More tariffs set to take effect overnight. Fed minutes as well, just around the corner. And some eco data through the week. Mike McKee has it all. Good morning, Mike.
Good morning, John. Well, the problem with this week's data and the Fed minutes is they're very backward-looking, and the whole situation has changed. To start looking forward, we're not going to get a lot of information for the Fed to make decisions on this week. Even if we get some movement in the CPI or PPI, we might get some initial tariff reaction in that. I would point you to Friday's Michigan sentiment report instead. See how Americans are reacting to the latest news. It will have data through Liberation Day, and it will have the tariff impact on inflation expectations. So Friday, look for the University of Michigan. Then next week we go to, on Wednesday, we get retail sales. That'll be important to see if people have started to cut back, whether or not there are tariffs, and that could influence the Fed. The Fed's going to have to wait and see at this point whether inflation or growth take precedence under tariffs or whether we even have tariffs. So I wouldn't expect a whole lot out of this week to move a lot of Fed thinking.
The same debate just continues. Mike McKee, thank you. Fed officials, to Mike's point, going around worried about upside risk to inflation, potentially downside risk to growth. Nancy Lazare of Piper Sandler seeing tariff-related inflation as a one-off and saying, quote, easing aggressively now would risk a sharp inflation reacceleration in 26. As of now, after the one-off tariff inflation hit to the economy in 25, inflation is likely to slow in 26. Nancy joins us now for more. Nancy, good morning.
Good morning.
Are you suggesting they just wait then?
I would prefer the Fed be more ease very, very slowly, because again, what you don't want to do is repeat what we did in 2021, which was eased in a temporary shock and then create way too much liquidity, and inflation indeed comes back. I didn't like the fact he used the word transitory again.
Not many people did.
Nervous. Yeah.
JP Morgan Asset Management, Bob Michael, on the program with us on Sunday evening as we waited for equity futures to open on the S&P 500. He said maybe this Fed couldn't wait until the next meeting. The next meeting's the first week of May. Can they wait that long?
Oh, I would say, again, this is not an interest rate problem. In fact, the lagged effects of a Fed easing cycle are still going to help the economy once uncertainty can come down and these price shocks can fade. So the Fed has already eased, let's not forget that. And as we move into the back half of the year, they could actually already help to support growth. So yes, later rather than sooner would be healthier for the long run inflation outlook.
What's the historic analog to now where we can get some sense of how inflation has behaved with tariffs at a time where potentially you could also see some sort of demand shock?
So you can go back to 2018, where you had two industries in particular that had big tariffs on them, both washing machines and furniture, and you saw an increase in price immediately, and then you had a decline in unit sales immediately, and then over the next year, you started to see prices actually decline because of that weakness and also the substitution effect. So again, it would be best for the Fed to be patient as we go through this price shock. See a dip in the economy, maybe 1% GDP growth as we move into the second and into the third quarter. And then by the back half, fourth quarter into 2026, you can see an incremental improvement in the economy. And the Fed doesn't have to do much to get that.
Some people would argue, including the likes of big Wall Street firms, and a number of Wall Street firms have predicted a base case now of recession, including JP Morgan. Why should the Fed look through that, given what the surveys are showing and given the fact that companies may come out and give some guidance other than Levi's, but may give some guidance to that effect?
Well, they may not look through it. They may incrementally ease. But again, the Fed has already eased. Our models were actually pretty optimistic for 2025, seeing a healing in the economy as we move through the year because of the easing cycle that we saw last year, lower bond yields that we have started to see. Now, oil prices are down. There are basic supports for the economy. This is a one-time price shock, and to ease too aggressively, again, risks creating this inflation next year.
Let's talk about those risks of it not being a one-time price shock. Yep. What are the sources of inflation that would concern you going forward from here?
Well, wage inflation actually has been very sticky over the past year. Even average hourly earnings have basically stopped slowing, even prior to the current environment, which told us that inflation was again sticky in 2024. And I think the Fed should heed that. And you've also seen it in some of the price measures, again, here in the first part of the year, where you've seen the ISM price measures increase pretty much across the board within the regional Fed measures.
Neil Duss has made a similar point from Renmac about the risk of second-round effects. He talks about the anxiety of the consumers right now, and you see it in the reports, in the surveys. They're anxious about higher unemployment in the future, and if that's the case, the idea that they're going to go around and bid up their wages anytime soon is difficult to get your head around.
Which is a reason why a lot of people aren't looking to that kind of inflation. Are you arguing that potentially a Fed rate cut of even 50 basis points could engineer that confidence at a time where the shock isn't coming from elsewhere?
No, I don't think a Fed rate cut. I think the next major issue for the markets are going to be, one, what inflation does in say, April and May. You're going to get a price shock, a big price increase from the tariffs that are being put in place. We think CPI could accelerate to around 5%, quarter-to-quarter annualized run rate, and that's going to take consumer spending down, and we're watching our daily consumer confidence survey. So no, we think the Fed can ease. They just can't ease aggressively. And they've already been in an easing cycle. They've pulled back on QT, and so let's not get carried away, because there are longer-term supports for the economy as we come out of this. and which we hopefully is by the fourth quarter of this year.
A couple of weeks ago, people were talking about the sequencing of the policies coming out of this administration, that the difficult stuff came first, the tariffs, some of the negative growth shocks, and then the pro-growth shocks come later on with respect to tax cuts and deregulation and other aspects. How much are people overlooking that as a potential catalyst for some growth and, frankly, potentially even inflation, and discounting how much of an upward stimulus that could be on the economy?
Oh, I think that is a very, very significant point. I started in the summer of 1981, and it was chaos in the summer of 1981. Volcker wasn't sure if he was going to be successful. Reagan did similarly. He was going to take some pain near term, allowing Volcker to do what he wanted to do. He fired people. I'm not comparing Reagan to Trump, but I'm just suggesting it's not unusual for an administration to do that. And the longer term positives are positives. To have onshoring, which I've been focused on for 15 years, is an incredible positive. There are people who want to work in factories. Clarity on the tax reform, deregulation, a smaller government. So there are some longer-term positives if we can potentially negotiate some with these tariffs. I'm also for free trade. I'm also for fair trade. And if we come out of this current turmoil with some fair trade, then yes, you can add that to the list of positives for 2020, 2025.
Nancy, I share that sentiment almost entirely. I'm pleased you said it. I think this has been a problem for a long, long time. It goes back decades. I think this administration, led by this president, has done a tremendous job of articulating that problem. The president's done it going all the way back to the 1980s. This is about whether this is the right policy executed in the right way to try and remedy this situation, Lisa. And I think they're two separate conversations. I think you've got to be able to acknowledge the former and then have a debate about the latter. And that's the struggle that a lot of people are seeming to have at the moment over the past week or so.
I'm so glad that you framed it that way, because I think a lot of people do agree that there's some issues, some problems that are very correctly identified by the administration. It's execution risk. It's this question of the uncertainty itself that does have a prolonged period of time, and how it is a key feature in the way that maybe these deals might be being negotiated or not, or maybe this is just simply policy, John.
Nancy, it's good to see you.
You too.
Thanks for dropping by. Thank you. Nancy Lazar there of Piper Sandler. Equities at the moment on the S&P 500 higher by 2.4%, all trying to work out this three-way game of chicken. Nouri Arabini said it's she, it's Powell, it's Trump. This is what Martin Norton of Empower's got to say. The Trump put may prove the only game in town when it comes to pulling the market out of its current spiral, but whether that exists is in question. Marta joins us now for more. Marta, welcome to the program. Let's talk about that Trump put. Does it exist?
You know, I think that's what we're all wrestling with, and I think the reality is that it's very hard to put a probability on whether the Trump put actually exists. It's hard to know whether we're going to see serious negotiations around these tariffs. Our concern heading into Liberation Day was that the market wasn't really pricing in the worst case around what tariffs could be. And as we look forward, now there's a bit more pricing in of the range of outcomes, but still that worst case remains elusive, especially if the Trump put remains elusive.
And Marta, as you know, we're swinging from is it a negotiation to are these the rules of the game from day to day. I'm interested from your perspective, how much damage we do in between as we try and figure this out over the coming weeks and months?
Well, I think in the very near term, a lot of the damage is happening and not necessarily likely to get more destructive, in the sense that we're already in a very heightened, uncertain period. Of course, if we see these retaliatory tariffs from China and the U.S. back to China, of course, that raises the stakes a bit. But I think the question is more on the longer-term outlook for where earnings land here. I think the markets can sustain a period of volatility, but if we see this tariff fight drag on into the next quarter, I think we're looking at an environment where we can see a lot of the earnings growth that people expected for 2025 come out altogether.
When you take a step back, there's a question right now about reordering the structure of global trade. These are pretty lofty goals at a time when people have counted on a classic 60-40 portfolio for a long time, where bonds were the ballast and stocks were the growth aspect. Do people have to rethink their longer-term allocations, given that there are some pretty massive changes that may be underway?
You know, it's a really important question, and what I come back to in this environment, this is very different than 2022. When we were in 2022, we could say diversification was of no value whatsoever, especially from the stock bond perspective. But as we sit today, I know we're not getting the kind of oomph out of long-term bonds that we'd like to see, but we are seeing bonds hold up in a way that they didn't in 2022. We're also getting that value from a sector diversification, consumer staples behaving, for example, very differently than what we're seeing from technology, and we're getting diversification geographically as well, you know, in terms of how we're seeing other markets respond to this environment. So I think we can argue in some ways that the 60-40 or the diversified approach is being reinforced in a way in today's environment that it hasn't been in, you know, in recent years.
Yesterday, someone made the argument that actually indexes are going to have less import right now than they have over the past decade or so, simply because specific companies are going to handle each of the potential regime changes differently. Apple is a perfect example, how they're in the crosshairs versus, say, a Microsoft that might be not as exposed. How do you counter that, the idea that the indexing era might be really entering a new territory?
Well, that's a very powerful point, and I would argue that the idiosyncratic, you know, conversation that you're raising in terms of how these different companies behave in this tariff era is something to watch. I would also argue that it's the market cap weighted effect that set us up for the kind of destructive price action that we've seen so far in 2025, excuse me. The technology, you know, accounting for a third of the S&P 500, the Mag 7 accounting for a third of the S&P 500. People were concentrated in a way that they didn't really even plan to be on an active basis just by passively tracking the market. And so I think we're seeing the risk of that unfold in today's environment. And I think that's one of the reasons that you would call for maybe looking to some of these other ways to index the market. Equal weighted is an extreme response to that, but there are different ways that you can add index-like exposure without having that market cap weighted exposure dominating your portfolios.
Marta, appreciate your take. Thanks for joining us. Marta Norton there of Empower. This could change how people invest. This is the system change that we're trying to get our teeth into over the past week. As we focus for good reason on what might happen to the cycle, there's going to be something much bigger than that in a decade to come, potentially off the back of these changes.
I love the point that you made, raising Stephen Myron's point that he raised yesterday, that essentially they're looking to restructure things, that the strength of the dollar was actually a bug, not necessarily a feature of the trade deficit and some of the structural issues. That might change. And if that changes, how does that shift the way people think about asset allocation? Also, we have a whole lot more debt, and how do we have to think about how our response is if there is some sort of recession in the near term? Look, my head's spinning, which is you can hear. And it's hard to kind of wrap your head around, so sometimes it's good just to say, well, maybe things will just stay the same.
America has had the privilege of behaving recklessly with its debt for a long, long time. I wouldn't take that privilege for granted. Yes, it comes with a structural bid for the US dollar, which is something that Stephen Myron has complained about. I understand that. But that's a delicate balance between those two things. You try and address one, you might upset the other. And I'm not sure that's something you want to do as you look to extend tax cuts in the not too distant future.
If you are the major trade partner of the world, then people need dollars to transact trade. That means that they want to invest in dollars to offset anything that happens to them. If there isn't that incentive, how do you have the privilege to act recklessly in the same kind of way with a deficit that's the highest level per GDP in history?
It's a delicate balance, that's for sure. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Billionaire Ken Griffin says President Trump's latest tariffs are a huge policy mistake and a tax on families that will increase costs for everyday items. Griffin, who is a Republican megadonor, urged people to reach out to Trump to get him to reconsider his tariff policy. Elsewhere, New York City's congestion pricing program is likely to remain in place for the next several months. The MTA and the Trump administration have agreed to a timeline that would keep congestion pricing tolls on through late October as both parties await a ruling, that all according to a court document. And in sports, the Florida Gators are the 2025 NCAA men's tournament champions after beating Houston in a thrilling championship game. The Gators came back from a 12-point second-half deficit, taking the lead in the game's final minute after trailing for most of the game. It is Florida's third ever title and its first since 2007. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. Thanks for this morning. Up next on the program, we'll set you up for the day ahead from New York City. You're watching Bloomberg TV.
makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The open about 39 minutes away. Equity futures up by more than 2% on the S&P. On the Nasdaq up by 2.1. On the Russell up by 2.5. Your calendar for the next few days looks like this. At 3 p.m., the president signing executive orders around U.S. energy production. At midnight, reciprocal tariffs kicking in. On Wednesday, Delta earnings just around the corner. Thursday, CPI plus another round of jobless claims. Friday, PPI and UMich sentiment plus bank earnings kicking off with JP Morgan, Wells Fargo, and Morgan Stanley. Let's head down to Washington, D.C. and catch up with Tyler Kendall from the nation's capital. Tyler, welcome back to the program. There has been, and I know this phrase gets derided, but a shift in tone, is it fair to say, in the past 24 hours?
Well, John, I think that is fair to say, in fact, that we are seeing this White House be a little bit more open when it does come to the negotiations, although it appears that there are still some big hurdles to cross and that we're not going to see any deals ahead of tomorrow. I'll also say that we're perhaps seeing a shift in tone from some on Wall Street, fresh reaction from Bill Ackman, who said that he thinks that some might have misconstrued his recent comments on tariffs, writing today that he supports President Trump using tariffs to eliminate unfair trading practices, and rather that he's actually advocating for a 30, 60, or 90-day pause to complete negotiations. Again, as you well know, President Trump saying yesterday that he's not considering such a pause as they try to strike some deals moving forward.
Tyler Kendall, thank you. Appreciate it. You know who's striking gold? Mike Platt at Bluecrest, gaining 20% on the tariff volatility. I always say this about Mike Platt at Bluecrest. My goodness, the ability of that firm to trade through different regimes, different moments, just repeatedly over the course of a decade is just nothing short of phenomenal.
Yeah.
Just absolutely amazing.
I would agree. I want to hear the secret sauce. I want to understand how they played this the right way, given the volatility that we've seen on an intraday and intra-hour, intra-minute point of view based on headlines. This is a tough time, and not losing money has been the benchmark. To gain 20% is pretty impressive.
I've been trying to get Mike to come on the program for years. I'll keep trying. I'll keep pushing, because this kind of performance is just absolutely amazing. Let's talk about where we are right now. Okay, so it's the difference between negotiating versus are these the rules of the game? People believe that the pendulum has shifted back towards, say, negotiating. So let's talk about negotiating. What can you negotiate right now? What is it that this administration would like to see? Because Vietnam made an offer, rejected. The EU made an offer, rejected. And now they're saying that tariffs and tariffs alone are insufficient, that this needs to be much bigger, much broader than just that.
Which goes to the question that you were asking, is this eliminating the trade deficit, or is this something else? Are these just eliminating, say, for Europe, the VAT tax and this question around non-tariff taxes or barriers to entry that might be different and non-comparative in the same kind of way? This week, I think the most important point will actually be Delta earnings. More than the banks, more than any of the economic data, which everyone will just simply ignore. But if Delta comes out and says people are canceling their vacations and businesses aren't spending, that indicates that actually this uncertainty and this paralysis is going to shift into something that starts to take hold. We hope it doesn't. Levi's, if they are the example...
I'll just come out and say nothing's going to change.
If they come out...
Levi's.
Okay, if they come out and they say nothing's going to change, and we haven't seen a shift in demand, and we've actually seen it revive since February, imagine how big that rally will be right now in markets.
Just got a great message. I always say this too, that we have the maturity mismatch between addressing trade versus execution. So policy has this set deadline, which is days, literally overnight tariff implementation. And then you've got the dynamic that takes years to take effect, which is onshoring of manufacturing. The mismatch between the two is the difference between the pain you need to take now for maybe the success down the road, and the destination is still not secure either.
It's a wonderful way of framing it to highlight how a lot of people do think that there are some changes that need to occur with trade and changes that need to occur with supply chains and manufacturing. The time that it takes, though, to do that is much longer than a lot of these companies are dealing with when it comes to facing off with some of these tariffs. Again, execution risk. That is what a lot of people are trying to understand.
We keep going back to the same question, and you said to me yesterday, we'll be asking that question for weeks, and I imagine tomorrow morning we'll be asking the same question. Are these the rules of the game, or can you negotiate them? Andrew Sheets of Morgan Stanley will help us answer that question alongside Chris Harvey of Wells Fargo, Richard Bernstein of Bernstein Advisors, and Ryan Pedersen of Flexport. That conversation, timely.
How much are people just leaving ships in the middle of the ocean with goods on them, not wanting to bring them in because they're not sure what they're going to have to pay for them and whether they can pass those costs along to the consumer?
Equity futures session highs were higher by 2.4% on the S&P 500. From New York, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have Take-Two numbers.
Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit. Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
All right, let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Big bounce in markets this morning, 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Shanali Bassick. And I'm Katie Greifeld. Bloomberg Open Interest starts right now. Coming up, after a wild 24 hours in markets, stocks look to snap a 3-day losing streak as countries rush to the tariff negotiating table.
More alarm bells, though, ringing on Wall Street. Goldman Sachs warns of a bear market, while billionaire Ken Griffin calls Trump's tariffs a huge policy mistake.
And you also have analysts echoing that gloomy take, with stocks facing another big test this week. Earnings season begins on Friday. Let's get a check on these markets right now. We had quite the fireworks yesterday. Ended up pretty neutral when it comes to the close. But then you take a look at where we are on futures right now, higher by 2.4%. A lot of that comes down to what the Treasury Secretary just said a little while ago, that tariffs are a melting ice cube and ice cubes get smaller. Look at the bond market, though. 10-year Treasury yields rose by nearly 19 basis points yesterday. That selling pressure continues to a lesser degree right now. Matt Miller up about 3 basis points.
All right, NVIDIA is leading the Mag 7 higher. The Bloomberg Magnificent 7 index is down 24% year to date, but this big heavyweight is up almost 5% in the pre-market. And if it holds, that's very good news for the indexes on which it's so heavily weighted.
And I'm looking at your auto sector for you, Matt Miller. I'm looking at Stellantis in particular because Union reported first quarter production in Italy down 35%. The firm is also looking into ways to help offset supplier tariff costs. Stellantis is down 2.7%. And the tariff messaging from the White House is keeping investors on edge. This morning, Treasury Secretary Scott Bessent told CNBC that he hopes tariffs will be, as Katie is saying, a melting ice cube. We're going to bring in Bloomberg's Tyler Kendall, who spoke with Bessent last night. She joins us from the White House. How quickly does the ice cube melt? Because, of course, we're hitting that April 9th deadline, rushing to race to meet those other countries to bring back the reciprocity here. How do you see this playing out even in the next 24 hours?
Yeah, hey, Shanali. Well, Treasury Secretary Scott Bessent told me that any deals ahead of tomorrow are not likely at this point, and that also everything is on the table, including potentially lowering the 10% tariff that's currently in place across the board, if that is what ends up coming from these negotiations as they move forward. He also told me that all countries he's optimistic about striking a deal with. Now, the difference between optimistic and realistic remains to be seen, as there is still so much uncertainty from this White House about exactly what they need to strike a deal, and also, of course, the timeline there. And we're also getting some conflicting messages from this White House. Just yesterday, a senior advisor to President Trump, Peter Navarro, penning an op-ed saying that this is not a negotiation, really doubling down some of his recent comments that any carve-outs or exemptions ultimately could undermine the business case when it comes to investment and reshoring in the U.S. Now, we should, of course, note that it is appearing increasingly likely it's going to take more than just lowering or eliminating tariff barriers, as well as eliminating trade surpluses with the U.S., because that is exactly what Israeli Prime Minister Benjamin Netanyahu had floated to President Trump yesterday in the Oval Office. And when asked if that would be enough, President Trump said maybe not.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there reporting live from the White House. Now, Goldman Sachs is preparing for a cyclical bear market despite the negotiations and tariffs. In a note out today, strategists say the event-driven bear market from tariffs could, quote, easily morph into a cyclical bear market given growing recession risks. Goldman Sachs chief global equity strategist Peter Oppenheimer joined Bloomberg this morning.
our economists believe that the probability of a recession in the US, for example, over the next 12 months is now around 45%. But indeed, if the full expected tariffs come through and there is no pullback, that would likely trigger a recession. And look, in a recession, typically profits do fall anywhere from sort of 10 to 20% or more, depending on what industries they're in and in what region.
And that, of course, is just one of several warnings coming from Wall Street in the past 48 hours. Let's discuss at the desk with Bloomberg's Bailey Lipschultz. And Bailey, I want to focus specifically on the Goldman call. So the idea there is that what we're seeing right now, it could turn into a longer-lasting cyclical bear market. That seems different and much worse than the event-driven bear market that they think we're in right now.
No, exactly, Katie, and that's kind of that prolonged downside. And when we talk to investors, the big uncertainty for them is what happens next. Obviously, as you can see, futures are up 2.5% right now, but that still doesn't signal, is this a near-term bounce? Is this the start of something that is longer lasting and ends up bringing major averages further down, double digits further down? Because when I talk to investors, if the tariffs are rolled back, we're going to rip. But if we continue to see the Trump administration not back down and lean into these tariffs, then that could kickstart another 10 to 20% downside. And that's really kind of the fundamental thesis. Again, if the Goldman economists are right now raising the probability of a U.S. recession to 45%, so that's becoming very quickly discussed. And even Larry Fink, I think yesterday, said most CEOs he talks to think we're already there.
He said the economy is weakening as we speak. He said that yesterday. That felt pretty dramatic.
That we're already in a recession. Yeah, that was.
Yeah, most CEOs, and then you also see that, frankly, during the small business optimism, you see that optimism fading for a lot of players. I also want to point out this note from Barclays this morning because interesting, they say that a lot of the deleveraging you've seen in the hedge fund industry, particularly with systematic funds, might have been washed out. But retail funds, where you excel here, I'm shocked at how closely you can keep an eye on those retail traders. It seems like there's a long way to go still.
Yeah, they're not capitulating, and they're not really worried because when you talk to retail traders, for the most part, the thought is every time prices move lower, it's an opportunity for it to be cheaper for the long run. But when we talk to some folks who manage IRAs, they are seeing some panic from older people who are closer to retirement. If you're in your 60s, maybe you do actually want to get and scale back your exposure to equities, because the big thing is you've been rewarded with back-to-back years of huge returns for the S&P 500, but at some point you have to pay for that volatility.
Matt, they have a word for that. It's cut your losses.
Cut your losses, something you got to learn to do. Bailey, thanks so much for joining us. Bailey Lipschultz from Bloomberg News. Now, even the biggest bulls on Wall Street are tempering expectations. Over the weekend, Oppenheimer's John Stoltzfus lowered his year-end S&P 500 price target by 1,100 points from 7,100 to just under 6,000. John joins us now. Great to have you on the program, John. I wonder, first off, if you think that we hit a bottom yesterday and now that this bounce is sustainable.
Matt, thanks for having me on the show. Always great to be on Bloomberg TV with you. Really, I don't think yesterday is, I think what it was, we had two things happen yesterday. There was the false news, that came out that there was going to be a pivot from the administration, and the market soared. And then later on during the day, with the news about negotiations with Japan, that kind of eased things. I think that, this is the beginning of the recovery process from this. Everybody was in shock by the degree of the tariffs. I think everybody had expected tariffs, but it was like a big difference from tariffs 101 at the administration's previous run in the White House, and now essentially tariffs 401, senior year, It's got to think here. The market's looking for cooler heads to prevail on this. I think there's opportunity, and those cooler heads have got to be from both sides, because the reciprocal action, for instance, from China doesn't help anything, because then you'll go back and forth like pickleball volley, wild stuff happening, and a lot of attention to it, but that's a lot of egos. The reality is this does present serious problems for businesses and communities and the as well as the consumer. But at the same time, you have to say one thing about this administration. It is actually addressing problems that have been kicked down the road for over 40, 30, 20, and 10 years as the world really moved to those who export to this country and those of us buying the stuff that they sell. And our loss of significant amounts of manufacturing that's key, whether it's in healthcare or whether it's in technology, that are really related to national security.
So, John, I think a lot of investors and analysts would agree with you that the intention is there, maybe quibbling with the execution of sort of reversing some of those dynamics. But I actually want to go back to what happened yesterday. As you phrased it, fake news. We got those headlines while we were on air on this show. I'll just say that X account, Walter Bloomberg, not actually affiliated with Bloomberg. But I feel like there might be a teachable moment there because the reaction was so violent to the upside. I feel like it really exposed the risk of being too underweight if and when we do get some relief in the form of headlines on tariffs.
Oh, Katie, it most certainly showed where the markets want to go. And the markets are looking at, the view is, its goal is beyond this. And related to when people ask us, well, what would you be putting on your shopping list right now? We've got to say it looks like technology, communication services, industrials, consumer discretionary, and financials, what we've liked for a long time here, because these have been among the most brutalized sectors in this thing. The overselling looks to us like at different points the negative pitch book that we'd seen in 2022, which predicted all kinds of things that never happened. The only thing that did happen is the market was driven into a bear market. That was looking like a winning volley there for a bit here. But I think yesterday what happened really points to the fact that if all of this is going to go to the ultimate negative, projected into infinity negative outcome, it's too awful to consider. You've got to figure, cooler heads will prevail. I mean, I'm so old. I was a kid, a little kid, but a kid who was interested in global politics when the Cuban Missile Crisis occurred. It looked really serious when Khrushchev was in Cuba, and Kennedy and both Jack and Robert were fighting them, but that worked out.
John, while we all wait for cooler heads to prevail, I want to point out where the VIX is right now, because even though you're watching futures rip this morning, really take a breather, you are still watching the VIX above a 40 handle or near a 40 handle. It is lower than we've seen the last couple of days, but this is still an extremely volatile market. How do you play that? Doesn't that mean that you can stand seeing your face ripped off in this market if you get in too soon?
Well, that's, it's funny. It's a real good question, Sonali. When we get asked that a lot, people say, do I back the truck up into this? Do I consider this being perhaps one of the best buying periods that we've seen in a while since COVID or since the great financial crisis? And we say, we wouldn't do that right now. We wouldn't be selling into this. We think very early it was too late to start getting defensive, but it certainly was a good opportunity not to look to buy the dips as much as buy the babies that get tossed out with the bathwater, that are those stocks that are likely to carry us higher going forward. But we think we're getting to a point where people, can feel more comfortable. Managers with more conservative mandates will actually be able to consider dollar cost averaging in this place and recognize the fact that we're not going back to the slide rule or the abacus or abacus, however one wants to pronounce it. Essentially, we're dealing with globalization becoming revitalized, diversified away from one country centricity.
Right.
The U.S. getting some of its manufacturing back, and in the process of that, probably a healthier economy than we've had in decades.
All right, John, you're sticking with us. We'll come back to you in a moment. That is John Stoltzfus. I do want to mention some breaking news in the form of a Truth Social post from the president. He says that he had a great call with the acting president of South Korea on the topic of China. Trump says that China wants to make a deal badly and that we are waiting for China's call. We'll bring you the details as we get them. But coming up, Apple set to snap a historic sell-off. We'll take a closer look at the stock next. This is Open Interest.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal-making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never. Ready? Go.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It would take years to even make that more than 5%, just given the logistics and the nature of India, in terms of as Apple tries to move some stuff there. Look, no company in the world is hurt more from once that came out of Trump's mouth in terms of Taiwan and China tariffs than Apple.
And that was Wedbush analyst Dan Ives speaking to Bloomberg yesterday about Apple. And shares are up pre-market again after the iPhone maker plunged 19% over the past 3 trading days. Apple seeing a wave of panic buying for iPhones as higher prices loom due to Trump's tariffs. Let's discuss with Bloomberg Technology co-host Caroline Hyde. So you are seeing a little bit of relief in the shares right now, but if this is just a pull forward of demand, I mean, how sustainable is that?
And will we not actually see it until its fiscal third quarter earnings? We've got May the 1st as the first set of earnings. We're going to get any sort of testament to what demand has been like of late. And KeyBank, another analyst, has just come out with a price target downgrade because they think there has been soft consumer demand even prior to the tariffs. And then you've got the likes of Dan Ives who are putting out comments like, if you bring it back to the United States and manufacture an iPhone here, it'll cost you $3,500. No one expects them to do that. But even by bringing more iPhones from India, for example, JP Morgan's saying, look, you're going to have to increase the price of your $999 Pro phone by at least $120. You're going to have to see the Pro Max go up by about $350. No wonder every store around America and the world right now feels like it's vacation time, like it's going into the holidays. Every person you speak to in an iPhone store serving customers says they're coming in, they're worried about prices, and they're looking to upgrade right here, right now.
Caroline, we thank you so much for joining us. Of course, this Apple story is one that we're going to be watching very, very closely. It's one of the giants in the room when we think about those trade talks. And we are back now with Oppenheimer Chief Investment Strategist John Stoltzfus. And I want to point out what's been going on this morning, because you are seeing futures edge higher after that brutal 3-day streak in the market. But part of this is because of what is coming out of the White House. For example, Trump speaking about the potential for a trade deal with South Korea, optimism around the situation with Japan. There has been so much negativity around these trade talks. Is there a scenario, John, that you see in which the U.S. does win out?
Well, Sonali, I'd have to say that when you look at the picture here, there is an awful lot of overcapacity in manufacturing around the world that needs to replace the U.S. buying power as the largest consumer nation in the world. If they want to just turn their backs on the U.S. and we wind up, essentially in some kind of a standoff here. The reality is, I think just as President Trump's constituencies are expressing their concern, making interviews to the press, we've already seen many of his supporters who wrote big checks last year saying that they're displeased with this. You can figure the same thing is happening to leaders around the world when it comes to addressing this, because it has to do with employment, economic growth on both sides of the fences. One of the things that we thought was ironic for quite a few months here was that the foreign markets, particularly the European markets, were outperforming the U.S. beyond valuation underperformance for almost a decade. And I've been a global investor for, oh gosh, almost the whole 42 years I've been in this business. So I like being diversified across the globe, but I'm underweight international. We couldn't help but think, people think that it's only the U.S. can suffer from a trade war. My gosh, everybody else, if you look just China needs the U.S. to a large extent. Their domestic economy is not large enough to absorb our buying power disappearing. And the same thing goes for Europe and elsewhere around the world. I thought it was curious that the greatest leniency that the administration showed in the tariffs really was overall with Latin America, which was interesting. In other words, bring the business back to home. We know that Mexico, of course, has regained its status as the largest exporter into the U.S., taking a lot of business away from China over the course of the Biden administration, the prior Trump administration, and let's see what happens now.
John, great to get some time with you. Thanks so much for joining us. John Stoltz was there from Oppenheimer, who's cut his target from 7,100 to about 6,000, but reserved the right to raise it again if things take off to the upside. Less than 10 minutes to go until the opening bell. We'll start the trading day with Matt Miskin of Manulife John Hancock. This is Open Interest.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Well, futures are surging right now after Treasury Secretary Scott Bessent told CNBC this morning If we're successful, tariffs would be a melting ice cube. Let's discuss with Matt Miskin. He is co-chief investment strategist over at Manulife John Hancock. Matt, great to see you in person. So the thing about ice cubes is they get smaller as they melt. So you could make the case that maybe this is a negotiation tactic. That seems to be what traders are doing right now. Do you think that this bounce, though, is sustainable?
Well, the rates rule everything around me line that last time we talked about, cream, actually still holds. And what I struggle with the bounce is that the 10-year yield is popping higher.
Yeah.
And so not only is the 401ks across the country failing lower balances, but now mortgage rates are going up. And that isn't healthy. We need actually a softer Fed tone and one where the 10-year yield...
Softer? You want an even softer Fed tone than we got from Jay Powell on Friday?
Pillow soft.
I think actually he was...
That guy was milquetoast.
He was hawkish, I thought. I mean, he didn't even express any concern about the volatility. All right, so there's a dog and a tail. The dog here is the nearly $150 trillion of consumer net worth across the country between real estate and markets. That is what actually drives economic activity. The economy, GDP, is like $27 trillion. That's the tail. So if stocks continue to do what they're doing, and they're their own worst enemy right now, because the volatility is going to make people more concerned about investing. You think about institutionals, risk-adjusted returns, but the wealth effect coming down in that consumer net worth is going to lead to weaker economic activity. And if Powell continues to be hawkish and just holding, I get it, four cuts are in the market right now. That's a lot. But
at the same time as Bill Dudley says, we should expect 5% inflation.
Right.
Put a pin in that. We're going to hold you over to the next block. And also, if we mention yields again, Shonali's going to bring up the basis point trade. So don't...
The basis trade. I wasn't going to do it, but thank you for that.
So don't encourage her. Matt Miskin is going to stay with us. Ahead of the opening bell, let's get a quick check on futures. We're in the green to the tune of 3 1/3%. This is Bloomberg.
First time, or got to many times go visit with Steve Jobs to try to get an Apple box to be our box. And we were trying to merge boxes. And of course they have Apple TV, we have our box, never actually happened. And in one of the meetings he said, well, you should give up because we're gonna win that. But you should put Wi-Fi in all your boxes. And that's how you'll win. And you should be the best pipe. And he said the best dumb pipe. So I went home, went to our chief technology officer and said, what's Wi-Fi? And today we have the nation's biggest Wi-Fi network. And we have more customers. And 90% of your cell phone usage, 90% is Wi-Fi. Right. And that's because 70% of all the bits going over the internet right now are streaming. And streaming wasn't here 10 years ago. So I sit here and say the most exciting thing about our company is what's coming in the next 10 years that happens in innovation around the world, hopefully here in America, hopefully Silicon Valley, in LA and everywhere else, Philadelphia, and that we're going to continue to have bits per home go up.
Bloomberg brings you breaking news 24 hours a day. powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
We've got a rally on our hands moments away from the start of the cash trade after Scott Bessent said on CNBC that tariffs are a melting ice cube. So that would imply we're going to get down to nothing. S&P futures right now up 3.4%. NASDAQ futures right along with them. You hear the opening bell on the New York Stock Exchange. You've got I believe it's the New York Fire Department, but some sort of firemen, and God, we're really thankful for all that they do. Down on the NASDAQ, you've got WISE, working in support of education, which also sounds like something that we should really be thankful for. But no companies ringing the opening bells in this kind of market turmoil. Katie, what are the stocks that you're watching move at the open?
Yeah, let's get to some company shares right now. We have to start with NVIDIA, leading the Magnificent Seven higher this morning after yesterday displays one of the most violent swings for U.S. stocks in years. NVIDIA shares finished about 3.5% higher yesterday, Shonali, amid the fray, and currently higher by about 6.5%.
How about a little more green for you, Katie? Not by much, but Walgreens is up by a little over 1%. People are watching their quarterly profit-topping estimates in one of its last earnings as a public company. The firm will not hold an earnings call.
Apple is snapping its biggest three-day drop since 2001. The company reportedly weighing a supply chain shift from China to India, not Italy. That would be, wow, that would be a real change. But they already make 4/5 of their phones in China. And how fast can that happen? Probably not very. Nonetheless, the shares are up 2.33%. Just the intent is enough to drive them higher. We're back with Matt Miskin, co-chief investment strategist at Manulife, John Hancock. Do you think the companies are going to be able to move their supply chains that quickly? I mean, also, does it matter if it's in China or in Vietnam or in India? Like, Trump wants it here, right?
This would take years to be able to really move those manufacturing plants back to the United States. And then also, there's just not the workers, the labor force to even do it in the United States. This isn't an actual movement that's likely to be able to happen. We think the tariffs are going to be a constant moving negotiation, if you will. But, you know, I don't know if it's a sinking ice cube or not, but what we're seeing more broadly is quality stocks are the worst performers this year. The better your balance sheet, the better your profit margin, the worse off you are in terms of markets. To us, that is a buying opportunity on a relative basis. And the United States is on sale. We have seen such a massive sentiment shift. You rewind 3 months ago, the United States was the only place in the world to invest. It was an exceptional market. Now, the sentiment around the United States, the United States is the underdog. And everywhere else is supposedly the better place to be. We like the U.S. on sale here on a relative basis within equities.
So let's look at that sale. Let's pull up what the S&P 500 sectors have been doing so far this year, because you're right, it's pretty bloody. And want to know where your shopping list gets started. You're seeing consumer discretionary down 18%. A lot of that is Tesla. Information technology down, but even energy, retail, financials, real estate. What do you like?
So technology for us is a buy because the quality elements of it. So they've got the best profit margins, best balance sheets, hundreds of billions of dollars of cash just sitting there. They could do buybacks while they wait. They could pay dividends. They could do a lot of things. Then we're insulating that technology sector with low vol. So that's healthcare, that's utilities, that's things people need versus what they want. So it is more of a barbell strategy, if you will, quality and low vol. We're trying to minimize volatility for investors here, and we're also bringing bonds into the portfolio, which have absorbed some of that volatility pretty well for us.
Yeah, you know, yesterday may be excluded, but I hear what you're saying, and I want to talk about the upcoming earnings season. It starts on Friday with the big banks, and I hear what you're saying when it comes to the U.S. is on sale right now. There's a lot of bargains to be found out there, but is that enough to overwhelm what could be a disappointing earnings season? Because you take a look at the stats from Bloomberg Intelligence, for all of 2025, they now see profits rising 9.4%, which isn't bad, but that figure was 12.5% at the beginning of the year. So earnings expectations are coming down.
And they likely need to come down more. That's a great point. So
and people are lowering multiples, right?
So and this is unfortunately, the game that happens with economic slowdowns. You get the multiple contraction, which is sentiment-driven, and then you get the earnings revisions. Analysts have not yet woken up to this new potential regime, and they have not revised down the earnings. So it is likely that comes down from high single digits. We think it's going to be low single digits. It might even be flat this year. So that is still coming, but it's all relative. So what earnings are going to hold up the best this year? That's the work you got to do within the equity market. And to us, tech, even though it has sold off, we think is going to hold up better because, again, the margins, the moats, all that good stuff, and then those defensive sectors of what people need versus what they want. And then, you know who doesn't care about earnings? The bond market. Well, the corporate bond market does, but the high quality stuff, they don't mind if it's weaker growth. And we actually are calling for disinflation this year. We think the biggest miss with basically analyzing these tariffs and everything else going on is the thought that inflation is going to accelerate. We actually think it's going to decelerate over the course of the year. That's going to be beneficial to bonds. Maybe the Fed cuts a little more than expected.
I was just going to say, to underline your expectations, or maybe better put, your hope for the Fed this year, how many cuts do you see, and where does the 10-year end 2025?
So our fair value estimate on the 10-year is about 390, so it's still 30 basis points lower, but that's without a recession. If we're in a recession by the end of the year, we think actually the 10-year could have a 2 handle on it. Ooh. And that the Fed's going to be cutting more than the 4 times that's priced in. We think the 4 times is basically just, hey, inflation is slowing. We're going to kind of do this more methodically. But the bond market has not priced in a recession by any means, even though the equity market kind of is. So there's still a lot of bond returns left. The Fed hasn't given you the green light yet on the bond market. They're saying red light, hey, we're not done here yet. We're still concerned with inflation, but that could leave them behind the curve if the wealth effect does diminish here, if the economy does slow more than expected. And that's good. Bonds and stocks are not acting the same. The correlations are dropping, which is great for multi-asset investors like ourselves.
Let's finish on that point, because if we do end up in a scenario where 10-year yields are trading with a 2 handle, what is the equity market doing? Because that sounds like a recession to me.
Yeah, it's still likely lower from here. So if you basically look at drawdowns, if it's a non-recession drawdown, expect kind of mid 20% type drawdown. We're already at, 17? We're most of the way there for non-recession. In recession, it's more like 37%. So we've got more. So for us right now, you're getting a lot of price discounts in a non-recession environment, but it isn't pricing in a recession. We are still leaning into bonds relative to stocks, getting some nice income while we wait, mitigating the volatility, and looking for some equity opportunities here as they sell off.
All right, Matt, it's always great to speak with you. Nice to get a good chunk of time with you this morning. That is Manulife, John Hyencox, Matt Miskin. Let's look under the hood because we have plenty of movers on our radar. I want to start with Levi Strauss, up 5%. Shares were up as much as 16% at the open. That would have been its most intraday in a year. That's after they reported earnings and seemingly shrugged off the impact from tariffs. Specifically, they said that tariffs will have a minimal impact on their margins in the current quarter. The CEO also said that the company would raise prices surgically, but you can see, Shonali, some of those gains coming back right now.
I've got another tariff story for you. I'm watching Micron because it's rising after a report that it is imposing a surcharge on some products sold in the U.S. to compensate for Trump's tariffs. You're seeing the stock up almost 5%, not the biggest gainer in the Philadelphia Semiconductor Index, but close to it. And you are seeing others, like Bloomberg Intelligence, react that this could dent demand, but clearly this tariff reaction, the early tariff reaction, is not hurting the rebound, at least on the onset. Now we're going to get a look at some other stocks on the move this morning. We are going to bring in Bloomberg's Sunita Sekova for that.
Yeah, we've been talking about deep buying. We've been talking about deals. Goldman Sachs just upgraded Eli Lilly. They saw a compelling entry point. The stock is up about 4% at the open. Of course, it had a very rough day on Monday. The stock fell after the Trump administration spiked a plan to pay for obesity drugs for Medicare patients. We're seeing a lot of optimism for the stock more broadly. We have 29 buy ratings according to Bloomberg. The stock dropped 13% over the big sell-off in the last 3 days, but clearly the buyers are stepping in. There is some good news and upgrades from Goldman Sachs. One interesting stat is they see the value tripling from 28 to 95 billion by 2030. So a lot of optimism for Eli Lilly from Goldman for sure.
All right, thanks very much for joining us, Denitsa Sakova there. Coming up, Stellantis offers to help its suppliers shoulder tariff costs. We'll look at autos next because there's a lot more than that going on. This is Open Interest.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Welcome back to Open Interest. A quick check on stocks. You have green across the board. Not quite session highs, but pretty close. NVIDIA shares up nearly 6% right now. That's why you see the NASDAQ 100 out in charge. We'll keep an eye on that. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Morgan Stanley is upgrading Charles Schwab in its hunt for more defensive exposures. The firm is also upgrading CME and cutting Robinhood. Next up, education technology company Chegg getting downgraded to a sell over at JP Morgan. The firm says that economic weakness will drive students to prioritize making money at secondary jobs ahead of education, which is pretty grim. And finally, GM getting downgraded to a sell over at Bernstein because of the tariff impact. The analyst says that the outlook for GM is, quote, clearly unfavorable. Matt Miller.
Well, let's stay on cars. The maker of Jeeps, Stellantis, is offering to help suppliers shoulder the cost of tariffs. The automaker has outlined a program which its suppliers can apply for as the initial shock of levies on autos and the coming duties on parts rock the industry. For more, we're joined by Bloomberg's Detroit bureau chief, David Welch. And David, so much going on with Stellantis. Their production in Italy has absolutely tanked to levels we haven't seen since the 1950s. It looks like they're shopping Maserati and Alfa Romeo. At least they've tapped a consultant to look at those units. So what do we know?
Well, look, the company's had a lot of problems. Its cash cow is really the U.S. business, and that business has stumbled. The European business, for any company, but especially Stellantis, is pretty tough. The margins have always been pretty poor, and they've got some of they're strongest in some of the weaker markets with their mainstream brands. So it's not a surprise that they want to shop these luxury brands in the same way that Ferrari was IPO'd a long time with. They're not going to get that kind of money like they did with Ferrari, but if they shop some of these brands, they'll get some cash flow, and it'll also help the company focus. I mean, if you look at Stellantis, it has a bigger family of brands right now than pre-bankruptcy General Motors did when GM was trying to manage stuff like Saab and the old Hummer brand and Pontiac and all this other stuff. It's just a huge burden to do design, product development, marketing for this big house that they've got. So if they can get a little bit of cash and narrow their focus, probably a good thing for them if they can make it happen.
David, did they keep Chrysler and Dodge? Because yes, those are two brands that they own, but they don't really make any products anymore.
Yeah, you do have minivans, which is still a decent business for them. Maybe the sports sedans, but do you need two whole brands to do that? That's really tough to see. I mean, what they could do with some of these vehicles that they need is just kind of like they did with Ram. It used to be the Dodge Ram, now it's just a Ram. They could still sell it at the same dealerships that sell Jeeps and everything else. And by the way, most of their brands in the U.S. are all under one dealer roof if you go to shop them. So they could have a minivan, and if they wanted to keep one of those rear drive sedans for fleet business and for sports cars, they could just brand it without an overarching brand and then have them sold at the same dealerships who are buying the rest of their line.
David, I've looked at some of the things that have happened since, for example, Porsche spun off. Didn't go that well. I mean, Matt makes a point that it worked for Volkswagen. So you have mixed success in spinning off brands. But in my mind, I guess I'm skeptical because the reason they all came together in the first place was to share the benefits of scale. So are those benefits deeply lost if you see some sort of separating, siphoning, and pushing things away from each other in terms of supply chain?
One of the issues, though, with these sports car brands and some luxury brands is that they don't share enough with the mainstream companies' brands. General Motors makes it work with Cadillac because it's they have two sedans, but it's largely SUVs, and so they're sharing a lot of SUV parts. When you're talking about sports cars, in luxury sedans, it's a different animal than most of the volume that mainstream brands are getting, which is all in small, medium-sized crossover SUVs. So, are they sharing enough to make that work? I don't know if they're getting enough out of the parts bin for them, and maybe a company like Volkswagen actually would be better because they've got a bunch of luxury brands that have a lot of hardware that could be usable by these brands. I'm not saying Volkswagen's interested in this. I'm just saying they're the kind of company that has made sense because they've already got luxury in their line.
All right, David, great to speak with you as always. That is Bloomberg's David Welch. And we also want to take a look at coal stocks right now, moving higher after our press secretary Carolyn Levitt tweeted or posted that today at 3 p.m., President Trump will sign an executive order to reinvigorate, quote, affordable, reliable, and clean coal. Peabody leading the charge right here, up about 10%, was higher by as much as 18% in the minutes after those headlines dropped. Core Natural Resources and Warrior Met Coal also moving higher on the day. Now, coming up, investors are bracing for sour corporate earnings as the impact of tariffs looms over Wall Street. We'll take a look next. This is Open Interest.
politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on in stocks. We're looking at a big rebound. You're going to hear the phrase turnaround Tuesday a lot, like you do every time there's green on the screen Tuesday and Monday was red. But here it's really serious. 3% on the S&P 500, and we were only down, what, 0.3% yesterday? The NASDAQ 100 up 3% as well, as tech stocks really lead the way. Even small caps are getting some love today, so some people really willing to place some bets. In terms of the individual stocks, NVIDIA is huge, a gain of almost 7%, and a $2 trillion stock, that means a lot. Tesla up 3.7%. This is a fascinating story that we're going to dig into because Elon Musk has said he thinks tariffs should be 0, at least between the U.S. and Europe, and that seems to go against really the morals of his best friend in the White House. Apple up almost 3% after a 19% decline in 2 days. We gave you the coal story just a moment ago, and then Walgreens Boots Alliance up only 1%, but after earnings kicking off that season.
Speaking of earnings, Wall Street is bracing as more corporate earnings roll out starting later this week. Now, investors are worried about the impact of tariffs on operating margins and earnings outlooks. Here with more, Bill Donahadrick of Bloomberg News. And you're looking at, for example, BI analysis, saying that the EPS growth in this first quarter is looking pretty low. It's looking at rising at the slowest pace since the third quarter of 2023. How are investors reacting to these new expectations?
I think the key here is the word uncertainty, obviously, because a lot of companies that are trying to look ahead over the next year, how do they make decisions in this environment? And hence you have analysts cutting down first quarter estimates for what they're expecting for S&P 500 earnings. But we also have a model from Bloomberg Intelligence saying that even with the ratcheting down that we've seen thus far, the estimates suggest that maybe they're a little bit too optimistic at this point and that we could see further downgrades as companies start coming out with.
And we just heard that from Matt Miskin, actually, that analysts are still too optimistic when it comes to what this earnings season holds. And it feels similar to the jobs report in that it's not necessarily about the numbers we get, because they're kind of stale in the context of, okay, the world has changed and theoretically will change when we implement tariffs tomorrow. How do companies even model what's going to happen? Are we expecting to see companies just pull guidance altogether?
That's a really good question, and it's a big possibility. And it really makes me think back to the early COVID months when a lot of companies, they were so uncertain about what the future was going to be holding. They weren't sure about supply chains and consumer confidence and all of these different things that they have to input in terms of looking ahead into the future. And so we have Dan Ives, for example, arguably the best known tech analyst, saying in a note earlier this week that with the current situation, he does not expect tech companies, most tech companies, to be giving any guidance on their first quarter calls. So we'll wait and see what happens. We're going to hear from companies pretty soon, but that's a stark reminder of the environment that everybody's dealing with.
Doesn't help to leave people in the dark. Lori Calvasina yesterday was furious that these companies aren't doing more to guide investors. And what we didn't get yesterday, guys, from Jamie Dimon was his weather forecast. We don't actually know how bad he sees things coming.
Yeah, although we have heard, even in the last quarter's calls, we heard some CEOs speaking out against tariffs. You're starting to see a little bit more of that in corporate America. The Restoration Hardware call was hilarious, right?
It's instant classic.
Yes. So do you expect some of these CEOs to really come out hard against tariffs?
Like you said, more are coming out. I think it's notable that somebody like Bill Ackman came out over the weekend saying something like, you know, this could be like a nuclear winter when it comes to the outlook, when it comes to the economy.
That's a weather forecast.
That's a really dire weather forecast. But those are really stark words, and that's somebody who had backed the administration, backed the president all along on a number of different policies. And so just to hear more people coming out and talking about, you know, what they're feeling and what they're seeing, what they're expecting, right, it's possible we start to see more and more as this drags on.
Well, just in the last minute we have with you, take us into how investors are positioning amid all this uncertainty. When you take a look at ETF flows, for example, I know that there's been a lot of two-way traffic.
So much two-way traffic, yes. It's a little bit difficult to actually look at the overall picture at this point because there is quite substantial dip buying happening with certain products. So for instance, a levered NASDAQ 100 ETF saw a huge inflow yesterday, which obviously it can look great in the short term when you get a bounce, but overall, I think there is still a bit of a sense of we have to wait and see what further information we get. Obviously, we're getting headlines about different phone calls that the administration is holding with different countries around the world, investors reacting to those types of things, but it's still a bit too early to form an overall picture.
Right, you mentioned that big flow. TQQQ, which is 3 times levered, the NASDAQ 100 took in $1.5 billion yesterday, currently up about 11%, Matt Miller.
All right, we're looking at stocks really jumping up here now, 3.5%, the gains on the S&P 500 as we get just about a half hour into the session. Coming up the next hour, Karen Pay of Franklin Templeton joins us. Plus, we get to hear from Snap-on's Nick Pinchuk, as well as Leland Miller of the China Beige Book. This is Open Interest.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure, it's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez, and markets are rebounding. The Dow, NASDAQ, and S&P are all up about 3% or better in early trading as China vows to fight President Trump's new tariff threats to the end. Mr. Trump says he'll impose additional 50% tariffs if Beijing doesn't drop retaliatory taxes. Kristen Myers at the financial website ETF.com.
The reality is that we do have a trade deficit with China, which means that we essentially import more from China than we do export. So China's tariffs on us are not going to harm us as much as our tariffs on them, at least when it comes to the American consumer.
Small business owners in the U.S. say they may lose their livelihoods if the president doesn't change course on tariffs. CBS's Jolene Kent spoke to the owner of a candle store in L.A.
Kristen Pumphrey started her business in the aftermath of the 2008 financial crisis. It survived the pandemic, persistent inflation, and high interest rates. But a trade war feels different.
How will President Trump's tariffs impact your business? We're calculating essentially what change that's going to have on some of our raw materials. Our costs are definitely going to go up. It's a challenge for sure.
The Supreme Court says the Trump administration can resume deporting alleged Venezuelan gang members if they're given hearings first. Chief Justice John Roberts has paused a midnight deadline for returning a Maryland man to the U.S. who was sent to prison in El Salvador by mistake. Attorney General Pam Bondi.
First of all, it was an administrative error as to why he was deported, and he is a known gang member. ICE testified he was a gang member, and we believe he should stay where he is.
Officials in the Dominican Republic say at least 18 people died when the roof collapsed at a nightclub in Santo Domingo. A local governor is among the victims. Merengue singer Ruby Perez, who was performing, is among the more than 120 injured. Crews are searching the rubble for possible survivors. 24 deaths, including 5 in Kentucky, now blamed on violent weather in the South and Midwest that's triggered devastating flooding. James Cornish helped his father get out of his home in Frankfort, Kentucky, when the water rose half a foot in half an hour.
I came down here and told him, it's like, we got to go. Can't wait anymore.
There are brand new protections for kids on social media. Here's CBS's Michael Wallace.
Beginning today, the default Instagram settings for children under 16 block them from live streaming or looking at nudity in direct messages. Only their parents can turn off those restrictions. Meta is also adding its existing Instagram restrictions to teen accounts on Facebook and Messenger.
The Dow's up 1,282, S&P ahead 172. This is CBS News. One of the stars is talking about Florida's men's college basketball title.
Will Richard led the Gators with 18 points and 8 rebounds on CBS and was a key part of the furious second-half comeback.
I think it just goes back to the trust we have in each other. I feel like we're a connected group, and I feel like as long as there's time left on the clock, we can give ourselves a good chance to win. So just trusting in each other and trying to make those plays to win the game.
Richard tells CBS Mornings the championship win over Houston will now point him toward the NBA draft.
For sure, having a good career in the NBA, I feel like that's the next step for me. But this is definitely one that I'll celebrate for a few weeks leading up to working for the draft.
Steve Kathan, CBS News.
Word in from Paris.
Smart people on every side are close to panicking.
The latest and last installment of Mission Impossible with Tom Cruise will premiere at the Cannes Film Festival next month. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are also streaming on YouTube, so head over to youtube.com and search Bloomberg Podcast Live. That's where you'll find us. Green day on the market here today. The S&P is up about almost 3.9%. We'll get the breakdown coming up with John Tucker and Bailey Lipschultz. Sean Donnan, Bloomberg News senior economics writer. He's got the big take story today talking about the U.S. and China and trade. We'll break that down. Ira Jersey, Bloomberg Intelligence chief U.S. interest rate strategist. What is this Federal Reserve going to do for the remainder of 2025? Chris Watling, CEO and chief market strategist at Longview Economics, will give us his view of the market. And then we're going to check in like we like to do with Henrietta Trez, managing partner at Veda Partners, to get her thoughts of what's coming out of Washington, D.C. these days. So I've got a lot to chew on this hour. Let's kick it all off with John Tucker and a Bloomberg Business Flash.
And it is a risk-on session. S&P 500, 193 points higher right now. That is up 3.8%, 52 on the index. The Dow Jones Industrial Average up 1,377 points. NASDAQ 100 up 721 points. That is a pop of 4.1%. And, of course, the S&P 500 pushing away from the bear market territory this morning. Treasury Secretary Scott Bessent said there's potential for advantageous deals with major trading partners. So that is giving the risk assets one of the reasons to rally today. As you look at the S&P 500, 476 stocks are higher, 23 are lower. At all 30 stocks in the Dow Jones Industrial Average, they are up right now. The leaders in terms of index points in the S&P 500, you have NVIDIA Corporation up 7.6%, Apple up 4.2%, Microsoft, that is up right now 4%. And after the wildest day for bond traders since the height of the pandemic in March 2020, some more selling today. Again, the Treasury market could be more of a reflection of the risk-on sentiment, but you have the two-year yield as the two-year pushes higher in price. That's pushing the yield down 7 basis points right now to 382. The 10-year yield is down to down 5 basis points to 423. Oil getting a bid today. NYMEX crude, American crude, up about 1%. Still just 61.32 a barrel. This feels like a People article. President Trump's trade advisor, Peter Navarro, facing a verbal barrage from President Trump's Doge advisor, Elon Musk. On social media this morning, the Tesla CEO calls Navarro, quote, truly a moron, end quote. Navarro went on Fox News and said Musk is a car assembler who wants to keep his manufacturing costs down. Of course, Musk has been appealing to the president, going over Navarro's head to reverse the tariffs. So there you go. We check the markets and the gossip all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Hi, Alex and Paul.
Hey, guys. Nice to see you, even though you've both been on radio for the last 12,000 hours. But, yeah, the Navarro Musk story is amazing. We'll see what now comes next. I feel like it's on Navarro now. All right, let's take a look at some stocks that are also on the move. We're joined now by Bloomberg's Bailey Lipschultz, Bloomberg News senior equities reporter. All right, what are you watching today?
Yeah. All eyes are on the market, but the biggest driver in the S&P 500, NVIDIA, up almost 8% right now, on pace for its best two-day gain since May. keeping in mind it's still down 22% year to date. So investors going back into Mag 7 stocks, colleague Bernard Goiter had a really interesting story out about how the little liquidity, lack of liquidity can drive some of these big rallies for large cap stocks as well as indexes. So while the S&P 500 is up 3.8%, NVIDIA is up about 8%, keeping an eye on the validity and how long these stocks can stay higher, just given we are still in Donald Trump's world for all intents and purposes.
And you have to argue, too, that it was just so oversold, right? Like, valuations come down so much.
Yep. And we've seen people point to the fact that, as you mentioned, we're on a brutal 3-day stretch, and it's kind of, we saw yesterday with the head fake, the fake headline, if you will, about potentially walking back. So I talked to some people this morning saying, you know, if that's what we get from a potential pause, only imagine what this means if Trump did fully pivot on it, but still obviously remains to be seen.
Palantir, PLTR, also another name that I associate with kind of AI in that momentum trade.
Yeah, momentum trade, and again, keeping an eye on that. Stock's up more than 9%. Again, this is a company that, when you look at it on the last 12 months, guys, still up 270%. Yeah. So pulling back from its peak back in mid-February, but the company is still very much part of that risk-on trade. Obviously, when you are really a part of not only some of those retail trader chats, favorites of individual investors, but you also get the bid from being a component of the NASDAQ 100, S&P 500. So we do see investors plowing and continuing to plow into those benchmark tracking ETFs.
Right. It's going to be a time, though, I think, until we actually get some fundamentals moving. All right, last up, what are you looking at?
Keeping an eye on insurers, looking at Humana, the best performer in the S&P 500. Stock is up more than 12%. Really? Also rallying our other managed care names. This comes after the Centers for Medicare and Medicaid Services published a 5.06% advantage capitation rate increase, which is better than the expectations for 2.23%. So analysts really applauding that will actually impact the companies on a fundamental basis. So fundamental news, Alex, and that some of that regulatory pressure that we've been seeing from the administration pushing back on insurers, maybe easing, if not getting a little bit better, though investors still keep an eye on how the Republicans' budget reconciliation process plays out and what actually ends up happening with Medicare and Medicaid cuts potentially that can offset some of those tax increases.
But interesting to see sort of when you get the flip side and something positive out of the administration, how quickly stocks can react to the upside. So, like, it doesn't take a lot to move that positive needle.
Yeah. We'll take it.
All right, Bailey, thanks a lot. Really appreciate it. Bailey Lipschultz, Bloomberg News senior equities reporter. For more like conversation just like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere that you get your podcasts. The question that I still have, Paul, is what is the off-ramp for tariffs at this point? Is it like a complete rollback of tariffs from other countries? Like, does Vietnam have to take back that 5% tariff that it has on U.S., and does that solve it? Or is it just having the conversation? Is that the off-ramp?
I don't know. We'll see. I mean, we're starting that. Apparently, there are 50 countries lined up to
70 now. 70. You not see the headline? Okay. We're on to 70
and
now.
I think that's the metric that the administration is using for success, is the number of countries lining up to speak and negotiate, presumably with the United States. And that is greeted very well by the marketplace.
The one that is not, though, is China, vowing to fight to the end on tariffs as it props up its own market. The Chinese Ministry of Commerce is saying that if the U.S. insists on its own way, the country is going to fight till the end. They've taken measures to reassure investors, like loosening the grip on the yuan to boost exports, also promising some loans to stabilize the market. We're joined now by Sean Donham, Bloomberg News senior economist, Economics. I can read. Economics writer. There we go. Joining us on our big take story. It's a deep dive into this issue. Fight to the end. What does that mean?
It means that we're setting up for the world's two largest economies getting into a pretty intense trade war, and that's going to be damaging for the global economy, and that's kind of what we look at in our big take today. I mean, we have seen just it's really hard just to stress how historic what Donald Trump did last week was. He raised tariffs in a way that we haven't seen an American president do in a century. He did it alone without Congress, which is something we haven't seen a president do beforehand. But for the global economy, he's really kind of introduced what we're now calling the Trump shock, right? We had the Nixon shock in the early 1970s. Here's the Trump shock. And that is coming up against something that countries have been dealing with for a few decades now, including the United States, and that's the China shock, which sucked up a lot of manufacturing capacity from the United States and other countries and led to the loss of manufacturing jobs and you can argue the rise of Donald Trump and his political power and his economic agenda. This is momentous for the global economy. This is a kind of complete realignment. And for Donald Trump, that's the point.
So, I think that the Nike story recently was just a great example of how the world's changed. I mean, you take a look at where Nike makes its products. You try to get away from your China reliance, which arguably they did by #1 market for them in terms of employees is Vietnam, then Indonesia, and #3 is China. Yet Vietnam and Indonesia aren't immune to these tariffs here. So this is a global story, isn't it?
Yeah, absolutely. And you've got to keep in mind also that countries like Vietnam and Indonesia are also getting shocked by China in the form of imports or exports from China of cheap goods that are going into those markets as well and present their own threat there. I mean, we are seeing all of these countries that are kind of stuck in the middle here, and that's going to be one of the big things to watch. I mean, I was just listening to your markets report, and I just keep thinking, we've had these kind of momentous days in the markets in recent days, and that's just the beginning of the story, right? Because really, these tariffs, the reciprocal tariffs, as President Trump calls them, take effect at a minute after midnight tonight. And really, the true economic effect of this is only just now going to start rolling through the global economy. And I think that's not going to go away, even if we get talks like the ones that he's talked about. Donald Trump is talking about good deals being possible. What does a good deal mean for him? I suspect it means leaving in a pretty hefty tariff on any imports into the United States.
When it comes to China, but I'm in the left, what issue with China truly does, though, need to be corrected?
Look, the big issue that economists point to is just simply the imbalance in the global economy. China and its consumers don't buy enough stuff from the rest of the world. The U.S. and its consumers buy too much stuff from the rest of the world. So really what you need to address in China is you need to find a way to get people in China to buy more. And that's kind of what Donald Trump is trying to do here. The question is whether this is the right way to go about it. I mean, if we get a recession here in the United States, then that's going to be historically, recessions have been great ways of kind of closing the trade deficit. Unfortunately, they're incredibly painful. We're going to be buying less stuff here in the United States. If we get a recession, that's going to lead to a kind of closing of these global imbalances potentially. It's not necessarily the way you want to go about it.
Sean, thank you so much. Appreciate it. Sean Donnan, senior economics writer for Bloomberg News, joining us from Washington, D.C. via Zoom. You can read more of this story on the Bloomberg and at Bloomberg.com/big take. Markets higher. S&P up 200 points, 3.9%. We'll have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash being brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/round the clock. Rally underway. Risk on today. S&P 500 up 4%. 202 points higher, 52.65 at the index. The Dow Jones Industrial Average is up 1,451. The NASDAQ 100 right now up 776 points. That is up 4.5% right now. Investors, among other things, focusing on the possibility of trade negotiations. Health insurance stocks, they're rallying. The Centers for Medicare and Medicaid Services finalizing a 5.06% average increase in payments to Medicare Advantage plans. You have stocks like Humana, that's up just about 13%. Data today, National Federation of Independent Business Optimism Index, this is small businesses, declining 3.3 points to 97.4 in March. 7 of the gauges, 10 components weakened. The optimism declined the most since June 2022 for small businesses. The bond market saw a huge sell-off yesterday. It was, in fact, the biggest daily Treasury sell-off since COVID, maybe raising the specter that somebody had to raise cash quickly. Ira Jersey, we're hoping, can explain that to people like me. 2-year yield up 8 basis points right now, 384. So you see some more selling there. The 10-year yield up 7 basis points right now, 425. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
Hello. Thank you so much, John Tucker. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries worldwide. They also cover stuff like the bond market. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, joins us now. The 2-day move that we've seen in the back end is tremendous. What happened?
Yeah, I think most of this is a liquidity issue. So if you look at dealer balance sheets, they're stuffed with bonds. And, given that the long end has a lot of duration risk and market risk, and you have to hold a lot of capital against those trades, it seemed like there was just, there was some outflows and people trying to sell that long end paper, and the dealer community just couldn't absorb it. We've had this disintermediation where high frequency traders and some non-dealer actors have tried to act more or less like dealers, but they don't step in front of a train like we had yesterday. So I think that's one of the reasons why you had this massive volatility. And look, yes, it was a very big move. In the 30-year, it was the 9th largest daily range, so high to low in terms of the treasuries in the last 25 years. So definitely a big move, but not like unprecedentedly big, right? It wasn't like a thing that we've never seen in our lifetime. But at the same time, like it does bring up the fear and the worry that a lot of the market structure changes that occurred a decade ago with Basel III and with some of the Dodd-Frank regulations, the issue with all of them is that they make the institutions, like the large banks, safe and sound at the expense at sometimes of balance sheet elasticity and therefore market liquidity. And that's what I think was a big reason why you saw such dramatic moves yesterday and probably a bit of the follow-on today.
So that's kind of where I want to go to, Ira, the liquidity in the marketplace. I mean, I remember my first day at Solomon Brothers. They walked me out onto the massive trading floor, and it was literally row after row after row of government bond traders. That's all they did. And that's liquidity to me. Is that still there at all?
It's not to the same extent that it was, and certainly even when I was on, working for one of the primary dealers, they had shrunk their footprint in terms of what they were trying to do in terms of taking risk, right? So, dealers are trying to match trades, match orders, all of those things, and one of two things has to happen if you're just trying to have the market deal with, client to dealer to client type of trades, and that's that you have to widen bid offer because, and if you can't want inventory to sell, which is what a lot of bond dealers have done, particularly in the corporate bond market and some of the structured products markets. But in the Treasury market, that's true to some extent as well. You need more balance sheet to be able to do that. So that means you have to hold more equity. And liquidity can be very fickle. So everything looks great until you have just a certain amount of risk that's trying to be laid off at one moment. And that's when you get these massive moves. There's a simple fix, at least temporarily, and that would be to exempt Treasuries from the supplementary leverage ratio of the large banks, because most of the large banks have dealer arms, and by exempting the Treasuries from the SLR, which is a benefit to the government, right? It would be in the government's interest to do this. You would increase liquidity across most of the fixed income world, but Treasuries in particular, obviously, because you can now own more Treasuries without having to worry about this extra capital that you have to hold against them.
Such a good point. Here is my insanely smart question.
Oh, boy.
Why were there so many sellers yesterday?
Yeah, I think there were a couple of things going on. I mean, tariffs are a big one, right? There's people who are worried that given that about a third of the Treasury market is held by foreigners, that with less dollars leaving the U.S., that there'd be less demand from foreign entities. Now, in aggregate, foreigners haven't been net buyers of Treasuries, but private investors have been very large buyers of U.S. Treasuries. Central banks have been shedding their Treasuries, while private buyers have been purchasing. And why? Well, if you're an insurer who insures oil on a ship, you have to own some Treasuries or some other U.S. assets because you have a dollar liability. That's the oil that's on that ship. Now, what happens if that oil winds up being denominated in another currency for that transaction? You'll have to hedge it using that other currency. So I think there is this little bit of a fear that the U.S. dollar, because of everything that's going on, might lose some of its reserve currency status. Now, it's not going to happen overnight. It's not going to be something that's going to happen within the next year even. But over time, there could be alternatives that crop up. The issue with, I think, the dollar story, and look, R.J. Child-Freeman, my colleague and the leader of our FX strategy team here at Bloomberg Intelligence, she's the expert on this by far. But the way that I view it is that the dollar over time, can lose its status against maybe the euro. Maybe there's more renminbi trades. The problem with all of those things is that you have to have very stable currencies, and you have to have enough debt for people to be able to, or assets anyway, for people to be able to purchase them in the open market, or otherwise you can't be a proper reserve currency the way that sterling was for a long time and the dollar has been since World War II.
Ira, great context. Appreciate it. Ira Jersey, Bloomberg Intelligence, Chief U.S. Interest Rate Strategist. Well, joining us in studio, he flew all the way here just to have this conversation, is Chris Watling, CEO and Chief Market Strategist of Longview Economics. Chris, there's lots of questions to get into, but let's just pick up on what Ira's talking about and the worries that the dollar could lose its status as a safe haven currency, as a world reserve currency. How real could that be in your world?
I mean, clearly it's being chipped away at the edges with the latest policy announcement with the tariffs. But I wouldn't want to overpin a one-day move. I mean, it looks to me more like maybe there's some forced liquidation for some sort of reason, some sort of funds blown up. There's been a lot of volatility. If you think about S&P moving 8% in one day, there are all sorts of things happening in portfolios yesterday. So, yeah, I mean, I think the bigger picture is U.S. exceptionalism was a well-accepted theme at the end of last year, and now it's being chipped away at quite heavily by the sort of policy announcements we see, particularly what we saw last Wednesday.
So what does that mean for maybe your economic growth forecast? I mean, both for the U.S. and globally, there's a lot of folks we're seeing bringing their estimates down for GDP growth and maybe even taking their inflation estimates up. What have you been doing?
Well, I mean, we've been talking about this idea of a mid-cycle slowdown for the last few months because I think Trump's initial policy agenda is negative for growth. But it does get better later on in the year as you get maybe some tax cuts into next year and some deregulation and so on. So I actually think the market's almost, the sort of fear's gone too far. It's as if, the price has driven the fear to beyond where it should be in terms of recession calls and that sort of stuff. There is a lot that's good about the U.S. economy. There's a lot of the private sector that's healthy. But, to answer your question, yeah, I mean, I don't think there's going to be a lot of growth in the sort of middle of this year.
So what do you do on a day like today? Is this a day to sell into the rally? Do you want to sell the rips here?
Now, I think this is day to buy. So, I mean, it depends on your time frame.
Sure.
But tactically, we started buying this morning. I wish we'd started doing it yesterday, frankly. But I think there's, if you look, when do you want to buy on a tactical basis in the market? You want to buy when everyone's panicky and fearful. And that was yesterday. That was a sense of a liquidation event. The market had been selling off for almost 2 months. It was 20% lower. I mean, that's quite a move. 20% lower prices in a small recession. I don't think it's going to be a recession. And I think we've had the sort of shock of Wednesday, and now we're into the sort of nip and tuck of negotiation and sort of ebb and flow. I mean, some news flow will be better, some will be worse. So I don't think it's the end of the economic world for America. It's not good. I wouldn't think I don't think it's a great policy, but it's not the end of growth. It's not the end of the S&P 500 and so on.
What were you buying, or what are you buying? Is it some of the tech names that have been such the leaders of this marketplace, or is it maybe more value?
I think if you're a trader, you buy the tech names because what went down the hardest bounces the hardest. But I think if you're an investor, you buy the cyclical stuff in the market because the shape of global growth is changing going forwards on a 6 to 18, 24-month view.
Do you need to do it in a nationalistic way in that you want to buy companies that are exposed to the country in which they actually operate? Like, is that going to be the way to think about things going forward?
Maybe there's a bit of that, but I think what the shape of global growth is changing, in that I think we're going to get the Western consumer waking up. We've had a very weird post-pandemic world.
Wait, we're waking up? I thought we were going to sleep.
I don't know what you guys are doing, but no. I mean, in terms of so if you look at a lot of the Western economies, including the US. It's really, a lot of it's really struggled for 2 or 3 years. Even parts of the US, think of housing activity, it's on the floor. I mean, it's terrible. We need lower interest rates, and that's what we're going to get out of this. And lower interest rates, monetary policy is going to stimulate Western consumers, I think, to really get going. I'll give you one stat. There's $35 trillion of housing equity in US household balance sheets, net of mortgage debt. And that was like 10 trillion 15 years ago. There is a ton of money and wealth waiting to be tapped. You just need the right macro environment. And I think we're moving towards that. It's a similar story in the UK, similar story in Southern Europe, and parts of Europe as well, Northern Europe are doing some good things.
30 seconds left. You mentioned Europe. That had been a very nice place to start the year relative to the US S&P 500. Is that still a play for you?
I think it's still a play for us. As always, at the end of sell-offs, everything gets sold. It's indiscriminate. But yeah, I like Europe. I think there's a lot going for it. Germany's changing. Southern Europe looks terrific. They've been deleveraging for 15 years. We're getting low interest rates. You're getting a defense fund. It's a long old list of positive factors, cyclical and structural, about Europe. So what Trump's done is he's woken the rest of the world up to get on with growing their own economies.
Yeah, I guess so. I mean, as we saw that out of Germany, maybe close to $1 trillion of spending on defense and infrastructure. So we'll see how that plays out across Europe. Chris, thanks so much for joining us. Really appreciate it. Chris Watling, he's the CEO and Chief Market Strategist at Longview Economics, joining us live here in our Bloomberg Interactive Brokers studio. The markets remain significantly higher today. The S&P 500 is up 195 points. That's 3.8%. The Dow, John Farrow, Dow, up 1,400 points, 3.7%. And the NASDAQ's up 670 points. That's 4.3%. We do have a bounce in yields. The 10-year Treasury yields up about 5 basis points, 4.23%. Alex Steele, WTI crude oil up a little bit here, just about $61.40 a barrel. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. That is a risk-on rally. S&P 500 up 3.8%, up 193 points right now, 52.56 on the index. The Dow Jones Industrial Average up 1,414 points. NASDAQ 100 up 740 points. That is a pop right now of 4.25%. With a clock ticking for the so-called reciprocal tariffs, they kick in after midnight tonight, Washington time. The Customs and Border Protection just updated the tariff schedule. By the way, just to remind everybody, tariffs are not paid by the exporter. They're paid by the importer when you pick that stuff up. China, interestingly enough, in the FX market has allowed the yuan to weaken, offshore yuan falling to the weakest on record as the trade war escalates with China. An unmistakable declaration of intent there. And among the most actively traded, well, let's do the leaders in the S&P 500 in terms of index point. NVIDIA right now up 7%, Apple up 4.5%, Microsoft 3.8% higher. And the best performing stocks in the S&P 500 on an individual basis, Humana and CVS, they're rallying after the Centers for Medicare and Medicaid Services finalized a 5.06% average increase in payments to Medicare Advantage plans. That's actually more than expected. So I do have an unofficial trade advisor.
Okay.
Really?
That's
the bartender across the street. So Noel, well, he's actually one of the owners of Bloom's Tavern. Bloom's Tavern, named, of course, after James Joyce. So he wanted a statue of James Joyce made with a bench, and it's sitting out front of the bar. So he went to China. That was the best price he could get, and it looks beautiful. But he was told, he was advised, when you pick it up at Port Newark Elizabeth, don't. Just default on it. And then he was told it will go to auction. And you have to find an auction broker that's approved by the Port Authority. And he said, nobody's going to show up to auction on a statue of James Joyce sitting on a bench, and then you'll be able to pick it up without, just for a fraction.
That's a lot of work.
Well, I'm just saying. I mean, he didn't go that
to avoid
route.
how much of tariffs at this point.
But you could have picked up a statue of James Joyce sitting on a bench for a cut rate price had he not paid.
Who doesn't want that?
I mean, yeah, I have so much room in my broken apartment.
So good in my front yard. Anyway,
that is a great anecdote.
That's the advice from the bartender.
This is Bloom's, like right over the corner, right? Like that Bloom's?
Yes.
Amazing.
Yeah.
Okay.
Around the corner. Yeah.
Excellent.
Not saying I go there a lot.
No. Not enough that they would talk about how to avoid tariffs with you.
Yeah.
JT, thanks a lot. Appreciate that. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. But the zeitgeist, you get it. Like how to avoid paying more money. That's at the end of the day what we're talking about. Henrietta Trace is managing partner and director of economic policy at Veda Partners. So it raises actually the question, Henrietta, is what is the off-ramp for tariffs at this point? Is it just being in a discussion? Is it actually rolling back a number? Is it zeroing the trade deficit? What is it?
Well, I'm just watching the Senate Finance Committee hearing with USTR Greer right now, and it's pretty clear that the off-ramp is not coming anytime soon. The president's trade representative is explaining in a lot of detail exactly how serious President Trump is about addressing every single trade deficit with every single nation from Vietnam and Malaysia to China, and it's plainly going to take a while. We had been expecting maybe some small-scale deals on smaller trading nations in the advance of tomorrow's tariffs going into effect. But those talks are going to take a while. They've already taken a while. They're stressing some things that have already happened, like India taking off its 6% digital services tax, which happened a couple weeks ago. So nothing has really precipitated since Liberation Day that should lead anybody to be optimistic that any of this is coming off anytime soon.
Is there any role here, Henrietta, for the, U.S. Congress?
No, Not right now. I keep titling my reports, T minus 4 days, T minus 3 days, because I keep getting that question from investors. When are lawmakers going to step in and take back some of their constitutionally mandated authority? What about the Grassley bill? It's got 6 or 7 Republican Senate sponsors right now. It might eventually have a House companion bill. That is nowhere near the sustained pressure campaign that would be required for Congress to be able to get 67 votes to overcome a veto hurdle from the president, which has already said that he would do. And, they're about to leave town on Thursday or Friday, if not before. Looks like these budget talks aren't going very well. So there's nothing that anybody should expect from Congress for the rest of this month and well into May.
Okay, so based on that, I guess I'm having a hard time understanding the off-ramps to certain countries like a Malaysia or Vietnam that don't necessarily have the money to buy the stuff from us versus, say, a Europe. Is there an understanding, as you're watching the W Trade representative speak, that there are tiers of different off-ramps, or no?
I've always thought that there were tiers. We saw that through the reciprocal tariffs going on at different rates against different countries. At this point, the combined China tariffs are over 100% versus Vietnam's at a lower rate. But the question I think that you point out so well, Alex, is that the tariff we got from Vietnam is what, 1.5%? So what is the goal here? To get it to zero? Great. Well, what did we just achieve? Almost nothing. So the pain that we are seeing, the manufacturing pain, I think is a real story that we're going to be watching for the next couple of months, if not years, as they just get completely frozen. We talked yesterday about Audi just abandoning some of their cars at the ports and not offloading them, not knowing what the tariffs are going to be. So the manufacturing disruptions across steel, inputs, aluminum, copper, there's so much there that is really going to go up the works and create a difficult ramp for any tier to be helpful to domestic manufacturers.
Henrietta, have we seen any recent polling about how people feel about tariffs? I mean, because it's obviously such a central part of President Trump's economic policy. Is there polling that people support this stuff?
President Trump's supporters do. President Trump's supporters view the recent stock market declines as, comeuppance for, I'm sure, probably some residual hangover from the Great Recession, and the bank bailouts. There's definitely that component. There's a difference between union households and non-union households and the way they're viewing the president's actions. But most of his supporters like the tough guy attitude and are not really as concerned about individual tariff rates and what it means. And I think this is something that's missed by Trump's voters right now, is that the market is a leading indicator. The market is pricing in recession now, pricing in 1.5 points away from GDP growth versus expectations, or 0.6% at least at the low end. They're going to see that ultimately play out. And that's what strikes fear in the heart of some of these members who are trying to push back against the president, because they have to run for re-election next year. Trump doesn't, but they do. So that's, I think, the only real leash on this. You're right to point out the approval ratings. It's going to be slower to hit polling data than the market reaction. But I do think that what's been really clear for Americans for many months now is that tariffs are taxes. The president can come out and say these are tax cuts, but we know in our heart of hearts that that is not true. And the American voter and the polling data consistently shows that this is one of the least supported areas of his agenda and that they constitute taxes.
I mean, my question was going to be about the Trump put. Like, we clearly see there is no Trump put in the markets, which means the Trump put has to come in the form of his polls and approval rating. And I understand that on the margin, right, if you poll specifically on tariffs, there's less support in his economic plan. But overall, his support ratings are still off the charts.
Yep. And I get asked now less about a Trump put because I think investors have internalized that he's not going to be swayed here. And now I'm asked often about a congressional put. So if you don't mind me weighing in on that, I think it's interesting to, recall I was there during TARP and the auto bailout, and I saw, as a staffer, how long it takes for these members to move away from their priors to a new position. And it's not stock market declines. It wasn't, the 700 plus point decline in the market on the day that we took the TARP vote. It's 3 consecutive weeks of real pain that get them to move away from their priors. And so I would encourage folks to not think about it as, the S&P has to decline anywhere between 1% and 3% or whatever on a period that we've already had. It's the duration. So today's moves, today's bounce is actually materially harmful for any congressional put being achieved, because they're going to say, oh, look, the market's correcting.
Right.
They've reached the bottom, they're
Right.
moving up, and they will dismiss it. And it's really a time horizon as opposed to specific amounts of losses.
Henrietta, thank you once again for joining us. Really appreciate it. Henrietta Trace, Managing Partner and Director of Economic Policy at Veda Partners, really has her finger on the pulse of what is happening in the halls of Congress as it relates to policy there. We're going to have more coming up. Markets are higher here today. This is Bloomberg.
Listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Alex Steele, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast Live. Let's talk a little healthcare here. One of the biggest trends really over the past couple of years has been these weight loss drugs. And one of the key issues has been kind of who pays for it. Sam Fazeli joins us here, Director of Research for Global Industries and a Senior Pharmaceuticals Analyst for Bloomberg Intelligence. Sam, I believe President Trump and the administration has rejected obesity drug coverage. What's going on there, and how does that impact that market?
Yes. Hi, Paul. Of course, what happened is that this has been something that was put together in the Biden era in terms of trying to get Medicare coverage for these obesity drugs. Remember, Medicare are folks that are over 65 years old and more likely to be overweight, not necessarily, right? But more likely to be overweight and more likely to have issues to do with overweight. So it's a very important group of individuals to have these products available for. But I think there is a general sense, and I think we had expected this, so this is not an unexpected outcome, that the Secretary of the HHS, Human Health Services in the US, is not necessarily a fan of obesity drugs. However, there's a little aspect here that's important. These drugs are also covered by Medicare for those who suffer from sleep apnea and cardiovascular morbidities. Those indications and that usage has not been withdrawn. It's just the use for obesity that's been withdrawn, or at least is not being proposed anymore.
So, what I mean, can that be? That doesn't make any sense to me. In that, like, the whole point of these drugs is to help obesity. How are they going to keep that distinction?
Yeah, but Alex, not that I'd like to necessarily agree with the kind of decisions that are being made or disagree with them. If you think about it, if everybody who has a comorbidity, for example, cardiovascular disease, kidney disease, sleep apnea, and the only people who are not going to be able to get it are people who are just overweight, nothing else. That's a little bit easier to swallow than if they said, okay, we're just going to ban it, because those elements of protecting patients, that is important for health. Now, if these other obese people ended up, the ones who are now not being included, just obese and no comorbidities, having one of these issues, they would be included. So I think the issue here is some folks believe that all of these things should be solved by eating better. Of course, we all want to do that and not eating too much, et cetera, et cetera. However, society shows us that that's clearly not possible for a lot of people, and they end up in a situation where they gain weight and they put in more energy than they spend. That's where the problems arise. But so I don't think it's really as bad as it sounds when you first look at it.
Novo Nordisk is down 30% year to date. Is that just the obesity play unwinding for this name?
Well, you would think to yourself, well, why would it for this name and not for Eli Lilly?
Right.
We've always believed that Lilly obviously has a lot more going on, but we all know that Lilly is particularly driven with the obesity aspect. We also know that the obesity drug from Lilly, Zepbound, has outperformed Novo Nordisk Wegovy. We also know that Novo Nordisk is based in Denmark, and there's this fight going on between, or at least heated conversations going on between the U.S. administration and the Danish authorities. So I think you can pile all these things up on top of each other and worry about Novo more than you would about Lilly.
All right, fair enough. What about the rest of the sector? What are some themes that are on your mind?
Yeah, so vaccines continue to be a theme on our mind, and the which of course there's always words that are spoken or statements that are written that seem to suggest that vaccines are a good thing. MMR is a good way of stopping measles, but they don't say you got to go out there and get it. That's what's missing. On the other hand, we also have an issue with regards to what I feel like is a I don't want to call it an attack, but an undermining of research in areas which are infectious diseases, which I just do not understand. Why a tuberculosis expert would lose their funding. These are not diseases that no virus has been annihilated. Maybe smallpox, but I think if you think about it, measles, we didn't have any deaths. We have them now. As soon as you let your guard down a little bit, it all explodes. So I am worried about that because I love the United States. I love coming there. And that is something that clearly is a worrisome aspect for me.
Is it shared to any extent in Europe, Sam?
Oh, I mean, of course. Vaccine hesitancy isn't a specific U.S. issue. The thing is that what you don't want is that hesitancy to be fed from top healthcare officials. Over here, we have that hesitancy. Don't forget, the person who put together the MMR study for the discredited MMR study and autism link is a UK individual. But that's been discredited. But the UK government and health services have continued to push that this is the best way to get folks protected. But so it's not, hesitancy is not just a U.S. issue. It's everywhere. What you need is health officials to be pushing it.
Right. All right, Sam, thank you so much. Appreciate it as always. Sam Fazeli, he's the Director of Research for Global Industries and Senior Pharma Analyst over there in London, Queen Victoria Street for Bloomberg Intelligence. Always appreciate getting few minutes of his time. Still holding on to some of these gains here. A little bit off the highs of the intraday, but still a strong day in the markets here.
Yep, you know it. All right, for our listeners in the U.S., here's a reminder. You can listen to us via satellite radio on Sirius XM, channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM, channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Tuesday, everybody. We made it to the second day of the week. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We got you covered on all angles right now on the equity rally that we're seeing. Michael McKee, Bloomberg International Economics and Policy Correspondent, coming up in just a moment. On small business optimism, NFIB, not great. We'll discuss. Plus, Nancy Daoud is Private Wealth Advisors at Ameriprise Financial. Get her outlook on the markets. Ana Ragrana, Bloomberg Intelligence Technology Analyst, the latest on Apple and the historic sell-off of that we've seen in that stock. And then Putnam Goyle will join us from Bloomberg Intelligence to kind of walk us through the apparel sector. There was a really interesting note out about H&M having raised their prices by a crazy amount.
Really?
In order to sort of survive all of this. So we'll break into that. But let's kick it all off with a Bloomberg Business Flash. And for that, we go to Charlie Pellet.
Hi, thank you very much. And here's what's going on this Tuesday morning right now. We are looking at a 1,000-point gain on the Dow Jones Industrial Average. Can we call it Rebound Tuesday? The S&P, though, well off session highs right now. The S&P is up 143. That is a gain of 2.8%. The Dow, by the way, up 2.7%. The Nasdaq Composite Index right now up 514. That is an advance of 3.3%, while the Russell 2000 Index of small cap shares is gaining now by 1.9%. The 10-year, 4.20%, but the 2-year, 3.80%. Gold up $23 the ounce, back above 3,000 now, up 0.8% to 3,007. West Texas Intermediate crude, 60.97 a barrel, up 0.4%. And Bitcoin lower now by 0.3%, 78,714. Treasury Secretary Scott Bessent says there is potential for advantageous trade deals with major American trading partners as overseas nations appeal to Washington for negotiations in the wake of President Trump's steep reciprocal tariffs. In an interview with CNBC, Bessent also said China made a big mistake retaliating against the U.S.
We are the deficit country. So what do we lose by the Chinese raising tariffs on us? We export 1/5 to them of what they export to us. So that is a losing hand for them.
Treasury Secretary Scott Bessent interviewed on CNBC. Levi Strauss maintaining a full-year outlook that excludes the impact from sweeping U.S. tariffs that are poised to hike the costs of clothing around the world. Stay with Bloomberg for the latest on tariffs and market reaction. Again, Levi Strauss down 2.1%. We've got the S&P off session highs, holding on to a gain of 2.8%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. Head over to youtube.com and search Bloomberg Podcast Live. As Charlie was just reporting, a very positive day in the marketplace today. Let's look under the hood and see where things are going at the stock level. We do that with Bloomberg's cross-asset reporter, Emily Graffeo. She joins us here in studio. Emily, what are you looking for?
So one of the best performing sectors today in the S&P 500 is the managed health index.
Okay.
And this is all coming after the U.S. government increased 2026 payments for Medicare Advantage plans. So I'm specifically looking at United Health. It had the highest intraday jump since 2020. It was up 11.5%. It's pared back a little bit. And then also Humana hit its highest level since February. The word, at least from Wall Street, is that the new rate on these plans exceeded even the most optimistic expectations. That's what Piper Sandler said. Just to go into a little bit more detail, the Medicare Advantage plans will see payments increase by an average of 5.06%, which is more than double the rate that the government proposed in January. And it also means that the government will now pay private Medicare insurers at least $25 billion more next year than current rates. So any insurers are up, and specifically United Health and Humana, two of the largest, are really rallying today.
And it also shows, like I've been saying, it doesn't take a lot to get a rally, right? When you have such oversold conditions. What else are you looking at?
So CVS Health, another potentially riding on the strength of the optimism in the healthcare space today. Those shares are up as much as 12%. But in addition to the Medicare news, the company said that it expects financial results to meet or exceed previously issued guidance. They also named a new CFO, and sometimes management switch-ups
can be helpful.
Depending. Sometimes they can be not helpful for the stock. But today, it's green on the screen. Evercore ISI said, we see investors unlikely to be overly worried about the additional management changes. Former UPS executive Brian Newman will exceed the current CFO. And that goes effective April 21st. And again, right now, it doesn't take much to see a rally in these shares.
Anything else?
That is all I have.
That is all we've got. Awesome. For more conversations like this, listen to our Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcast. Does this rally surprise you at all, Alex?
No. And I say that because Julian Emanuel of Evercore ISI was on TV with me and Romain Bostic on Friday.
Yep.
And he said, you're going to have a gap down on Monday, and then by Tuesday, you're going to have a turnaround Tuesday, and he was right. But it doesn't mean that you're out of the woods. The question then becomes, how long does it actually last for?
Gotcha.
How long does the bounce actually last?
That sounds right. We had some economic information data come out today. U.S. small business optimism declines by the most since mid-2022. Michael McKee joins us, international economics and policy correspondent. He's down there in Washington, D.C. Why, I don't know, but he chose to. Michael, what did you make of this, the small business optimism data? Is it one data point, let's not pin too much on it, or does it have some different meaning?
I'd say it's the former, Paul. The small business people surveyed by the National Federation of Independent Business tend to skew very Republican, and after Donald Trump's election in November, the confidence index went way up. It's been ratcheting down ever since, and this sort of tells you that small business owners are seeing the same headlines that everybody else is, and confidence is falling off given the possibility that we'll all have to pay more money for tariffs. We've seen the same thing in the Michigan and Conference Board and CEO surveys that have been out recently. What's interesting in this is in the sub-indexes, the number of people who are thinking about making capital expenditures and the number of people who are thinking about hiring drop, and the people who think that the economy is going to be better 6 months down the road drop significantly. So they're reflecting the same sort of fears about what might happen because of the trade war that other people are.
So, and also this is so interesting, Mike, because it like sets the base, right, for when you actually do have a tariff impact. Was there any read on like how small businesses can manage that kind of pricing and that inventory?
No, not in this particular survey, but experts say that small businesses are going to have a much bigger problem because obviously they can't carry the kind of inventory. They can't stock up ahead of time in the same way that big corporations can. And it's harder for them to raise prices because they're already, by the nature of their business, charging in general a little more than the major retailers. So it isn't easy for small business to deal with something like this.
What's the Fed's role here? How do you think they're looking at all this data here, Mike, and maybe some of the market gyrations over the last several days?
Well, they're looking at bid-ask spreads when you talk about looking at market monitors, because if the spreads are tight enough, it means that people are buying and selling okay, and there's not a problem. They would only get involved in the markets if there was some sort of systemic disturbance. As far as the drop in markets, they don't really care. It's not their job to worry about whether you make money or lose money in the stock markets. What they will be watching is if you do see big drops in the wealth effect from the stock market, or people cutting back for other reasons because they're paying more for the things at the grocery store, those will rebound into the economy, and that will be something that the Fed has to deal with. But the question at this point, as we've been saying for quite some time now, is it going to be growth, or is it going to be inflation, or is it going to be both that they have to deal with?
I mean, it really feels like from what the Fed officials have been saying that inflation is still their biggest worry. They acknowledge the downside potential for growth, but that the inflationary scenario is really what's stressing them out.
Yeah, inflation is always and everywhere the Fed's prime focus, shall we say. And we know that tariffs are going to bring prices up. The question is, does it bring them up more than just one time? Right. Do they keep going up? Whereas with growth, you do have a ratcheting down. It won't fall off a cliff immediately. The pandemic was the one exception to that rule. And so they would have some time, more time to react. And also, they haven't seen the signs yet in growth of a problem. They haven't seen any problem with the labor market. So right now they're keeping an eye on inflation to be the first canary one way or another.
And on that front, Mike, we're going to get some CPI and PPI data later this week. Still too early, presumably, to see any upward pressures?
Pretty much so, Paul. We might in the PPI because we had a lot of imports of industrial materials for factories and producers in December and January in particular, and it is possible that some of the people overseas took advantage of that and raised prices. But it's too early to really see it in the consumer numbers because we haven't had the tariffs really imposed on them yet.
Which leads me to, why are you in D.C.? Which leads me to the FOMC minutes tomorrow. I mean, we'll talk to you tomorrow too, but what are people most excited about learning in the minutes?
Oh, people always want to know what the Fed's view on inflation is going to be, and particularly after this meeting, how they put together their views on what we were going to see in terms of the economy going down the road, the summary of economic projections, the dot plot. Most Fed officials that I've spoken to since then say, we didn't put a lot into this because we didn't have any visibility into what the administration was planning. So it may be that this information is pretty stale, particularly since it comes out on the same day that the president is, in theory, imposing all of these tariffs.
And Friday, I don't know, we get the University of Michigan data here. This really got my attention like a month ago when it really started to show that people maybe were a little bit concerned in terms of their current sentiment, and we saw some, meaningful moves in inflation expectations. How is the UMich data kind of perceived by the marketplace?
Marketplace is taking it on board as indication of concern among consumers, but they're going to be watching next Wednesday when we get the retail sales report to see if Americans are acting on that kind of information. The Fed looks at it in pretty much the same way, but they will be watching the inflation expectations numbers because they want to see if there's any chance they start to become unmoored. People start to think inflation will be cyclical rather than a one-time effect.
Really good stuff. Mike, super appreciate it. Michael McKee. Oh, wait, no, what's the chart you're going to send me today?
I think what we have to work on today is imports and exports from China and what the Chinese, what we actually send them versus what they actually send us when you look at value added as opposed to just the overall price of a good.
Mike, you're down in D.C., and I'm sure you're hearing the scuttlebutt and chatting with people here. What's the feeling down there about tariffs in general, and perhaps the way President Trump is imposing these tariffs and maybe open to negotiation? How do people down in Washington feel about it these days?
Well, in general, the view is that it's a mistake, that tariffs don't work, that this is going to be a problem for the overall economy. Folks in the administration doing their best to put some lipstick on the pig. But in general, the feeling here is this is going to be an issue and a problem, and they're wondering how Donald Trump gets out of this. What is the actual end game here?
Right. No, that's a great point. Mike, appreciate it. Thank you very much. Michael McKee, Bloomberg International Economics and Policy Correspondent, joining us on all things economics. We're looking at the NFIB, also looking ahead tomorrow to the minutes as well as CPI as well. Okay, now we're going to head to David Weston, a Bloomberg television anchor for Wall Street Week. He's speaking with former U.S. Treasury Secretary Larry Summers. They'll be speaking in-depth interview on the trade policies out of the Trump administration.
For our Bloomberg audiences worldwide, I'm David Weston. I'm joined now by the former U.S. Treasury Secretary Larry Summers of Harvard. Larry, thank you for being back with us. When we talked just a week ago on Wednesday, the day of the announcement of the tariffs, there was a lot yet to be determined. The markets have been through an amazing amount of volatility since then. 3 down days. They're sharply up today. You've been quite explicitly critical of what President Trump has announced here. Do you feel better today because the markets are coming back?
Sure. I feel better anytime instability seems to be calming, but be not confused. There's only one reason why instability is being reduced, and that is there's a growing hope in markets that a larger part of these policies are going to prove transitory and reversible. This does not reflect any kind of market endorsement of the approach that the president has followed. Rather, it reflects a judgment that the president might recognize the reality that markets are telling him about, that many of his advisors are telling him about, that corporate CEOs across the country are articulating, that this kind of wholesale tariff policy is simply bad for economic performance. We're seeing some signs that the administration may recognize that.
We're seeing signs, but do we have a better sense of the goals in the process today than we got from the Rose Garden last Wednesday?
I don't think so. I think this is fundamentally a improvisational effort. You could tell that when you knew that there was a policy based on tariff reciprocity that didn't use any data on the tariffs of other countries in figuring out how to reciprocate. You could tell that from the blatant contradictions between what presidential advisor Navarro was saying and presidential advisor Treasury Secretary Scott Bessent was saying. You could tell that from the degree of division between close outside advisor Elon Musk and many members of the president's economic team. This is a policy, it's a hugely consequential policy, but by all appearances, it's being improvised on a daily basis, and that's creating huge uncertainty. But it's only uncertain, there's only uncertainty if things go in both directions. And today happened to be a day when things moved in a positive direction. I hope that the moves to back off these policies can continue, but we'll have to see. I suspect we're going to have volatile markets for some time to come, and no one can know, but my judgment is that I'd be surprised if the bottom is yet in with respect to this phase and markets.
How bad could it get?
Oh, I think the likelihood, I think it's more likely than not that we're going to have a recession, and in the context of a recession, we'll see an extra 2 million people be unemployed. We'll see losses in household income that are $5,000 a family or more. We're very likely in the context of a recession to see markets reach levels significantly below their current levels. So I think we could be looking for fairly serious economic problems, and I think it will cast a shadow forward, because if we have a recession, the budget deficit will go up, the accumulated debt that we have to deal with will go up, there'll be financial distress that will affect higher risk companies and also higher risk countries in the global economy. But David, there's a central thing to understand about this moment of economic and financial difficulty. To borrow a word from the doctors, it is our first iatrogenic recession, our first iatrogenic financial crisis. Iatrogenic illness is when you go into the hospital and you catch an infection there. It's when the people whose job it is to make things better are the active agents of making things worse. And iatrogenic illness, staph infections and the like in hospitals is a major preoccupation for doctors. This is an iatrogenic economic challenge. There is nothing in the outside world that is causing this challenge. It is induced by the words and deeds of President Trump and his administration. The good news about that is it could be resolved with words and deeds of President Trump. If they backed off these policy errors, I think there would be a substantial resumption of normality. But as long as a hospital maintains unsanitary conditions, its patients get infections when they enter. And as long as these policies are being pursued, we're going to see substantial volatility in markets, substantial recession risk, substantial damage to middle-class families.
So just to follow up on that, is there any remedy for the patient other than for the chief doctor, that is President Trump, to back off what you just described as policy errors? Is there anybody else who can save us?
Look, depending on what happens with other countries and how they handle their diplomacy, it may be easier or harder for him to back off these policies, depending upon how the business community responds. There may be more or less ability to create an environment where there's a backing off of these policies. But there's nothing complicated about this. You impose huge tax increases on households in an uncertainty-creating way that's also damaging to established business patterns, and the economy turns downwards. There's nothing subtle or sophisticated about this. This is introductory economics. It's the kind of question that could have been on an introductory economics exam for decades. Suppose the President of the United States decides suddenly to impose a massive tariff tax increase on products from all over the world. What will happen to the economy? And any B student will know that the answer to that is that it's a supply shock that raises prices and raises unemployment as well, and makes the economy less efficient and adds substantially to uncertainty. This isn't some sophisticated, complicated thing to analyze.
Larry, thank you so much for being back with us. Really appreciate it. That is former U.S. Treasury Secretary Larry Summers of Harvard.
All right, that was Bloomberg Television's David Weston speaking with former U.S. Treasury Secretary Larry Summers about the tariff policies coming from this Trump White House. Markets still higher, although off the highs today. Let's get a check-in Charlie Pella right now with the Bloomberg Business Flash.
I thank you very much, Paul Sweeney. Let me quantify that in terms of percentages. Absolutely right, higher, but we're off session highs. Have been up as much as 4%. Right now, looking at a gain in the S&P, up by 2.1%. So bottom line here, well off session highs. We've got the S&P advancing now by 105.5167. Dow Industrials up 771. That is a gain of 2%. The Nasdaq Composite Index up 386, up 2.5%. Again, keeping the equity markets all in context, the S&P up 2.1%, have been up by 4%. Today's bounce, though, does bring relief to investors rattled by intense swings following a sell-off that chopped trillions of dollars off of global markets last year. S&P higher, the Dow, Nasdaq also advancing. Russell 2000 up 1.2%, 10-year 4.19%, the 2-year 3.78%. Gold up $24 the ounce, 3,007 up 0.8. West Texas Intermediate crude has reversed course. It is now lower by 0.3%, 60.49 a barrel, and Bitcoin now down 0.8%, 78,293 on Bitcoin. So again, recapping, we're well off session highs, but still a gain of 2.1% on the S&P. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, thanks so much, Charlie Pellet. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We got you covered on all the bases, internal and external sourcing. All right, we got a pretty fierce rally underway here. My question is, does it actually last? Nancy Daoud is private wealth advisor at Ameriprise Financial, and she joins us now, also CEO of Opus Advice First. Nancy, I appreciate that you're going to be a long-term investor on this, but just with our decades of experience here, when we take a look at a market move like this, after oversold conditions, does this bounce last for a while?
Well, it's hard to predict, obviously, but I do expect a great deal of turbulence. I mean, there's no doubt that this was somewhat expected, maybe not to the degree that it occurred. You know, the first quarter was like feast and famine, you know, and the first half of the first quarter was phenomenal, and then the second half just took it all back. So the Magnificent Seven stocks that had propelled the market prior are the same stocks that dragged it down. However, like you said, longer term, I still feel that we should be bullish. And in these turbulent times, although it was much more severe than expected, we should really look at this as much more of an opportunity, because up times last a lot longer than down times. And we just lose sight of that when things are so scary, like they happened in the last few days.
So how does one reposition, Nancy, if at all? Do you just kind of stay the course with your portfolio allocation? Do you try to maybe buy some things that were now more attractive? How have you kind of altered your view, if at all?
Well, clearly, staying the course or time in the market has always been trying to time the market, because we have no idea if we've hit bottom or not. And if so, you know, how do you time that? There's no way to do that. However, if you do have longer term goals and some excess cash that is available that you are willing to invest in the longer term, there's such an opportunity. I mean, the sectors that have taken the biggest beatings are financials and technology. So that's certainly an opportunity. And we know that ultimately those things will come back. Just don't know when. But I think the biggest message is that in the near term, there will be significant volatility.
That's to be sure. The idea, though, that we go back to what we knew before, is this time different? I mean, is the U.S. exceptionalism, the rush into U.S. assets we've seen over the last decade, what's your level of conviction that that still holds?
You know, I can't claim to be an expert on politics or economic policy, but I do know, having been around a very long time, is that history keeps repeating itself with the markets. You know, the underlying variables may be very different each time, but ultimately the math rules, because that's how markets work. And so we may have a lot of emotion due to more information and a lot of propaganda, both, you know, positive and negative, coming at us. But ultimately, things level out and revert to the mean, because the math will always rule in the end. And that's what, when you're buying a stock in the market, you're buying the balance sheet of that company. So corporate earnings are important, And corporate profit and economic profit fundamentals are always going to be the determinants in the end. And those right now are actually quite solid. Now, can tariffs have a negative impact? Absolutely.
So, Nancy, how does fixed income work into your outlook these days?
Well, if you've gotten into fixed income in the last few months, you're feeling pretty good because that has been a very big stabilizer in the last few weeks with all the turbulence. And I think fixed income prospects look pretty good. Just watch the duration and go for investment grade. But it's very likely that the Fed will cut rates again. We just don't know when and how much, but probably at least a couple of times this year. And I think it's certainly an opportunity with stabilization and diversification of a portfolio at this time.
Nancy, thank you so much for joining us. Always appreciate getting a few minutes of your time. Nancy Daoud, private wealth advisor, Ameriprise Financial, joining us from Miami, Florida via Zoom here. One of the names that's been really bouncing back a little bit here today is Apple, up 1.5%. We see some stories that people rushing out to get their Apple iPhones literally today before tariffs may take place. And the question that calls into question, kind of just talk about the longer term story there with Apple. Let's do that with Anurag Rana. He's senior technology analyst at Bloomberg Intelligence. Anurag, what's your feeling about tariffs and a big consumer-facing technology company like Apple?
Yeah, I mean, this is the one company in our space that are in our coverage that is absolutely impacted by all of what's happening. And frankly speaking, this rushing to get the phones right now is not going to save them if these guys don't figure out a way to, either get an exemption from President Trump or the U.S.-China, trade deal, becomes more closer to each other.
I mean, in some ways, Apple and Nike remind me of each other in that they did diversify away from China, and yet those countries they diversified, and maybe Apple didn't do as much as Nike, still wind up getting hit. What would it look like if Apple had to build the stuff in the U.S.?
I think in the absence of robotics, it's very difficult to do that. I mean, you need a massive firepower of human beings and technology to do it. Now, if there's a way to take the human equation out of the that particular process, yeah, it can be done anywhere, but we are not there at this point. But more importantly, frankly, think about it from Apple's point of view as well. They do want to invest more in China. They do want to invest more in India and other local countries because that's their next growth driver. I mean, they don't have that many more phones to sell in the U.S. market or the Western world for that matter. China makes up 20% of their revenue. There is no logical reason they shouldn't be, investing over there because that's where the growth is.
What have we seen estimates, earnings estimates for Apple and maybe even some of the other technology companies come down yet?
They have come down a little bit, Paul, but on an aggregate, I think there is a long way to go before all of this really shapes up. And I think people are waiting for, perhaps a deal right now with all the different local governments or respective countries to adjust those, and we'll find out more on May 1st. But remember one thing, with all of this, Apple still hasn't really, issued a big press release as to what the impact on growth rate could be. They have given some guidance for this quarter, but that seems to be okay. But when they come out and give guidance for next quarter, I really don't know how they're going to do it without understanding, how some of that margins story may play out.
I mean, they have to have like a range of scenarios. There's got to be like a fan chart that these guys are going to have to present for all of these companies. Is the biggest issue that their costs are going to rise because the stuff that's imported from China will cost more, or is it that their sales, say, abroad will be hit?
I think it's a mix of both. For me, the second part is a very big problem because that's, if you look at it, any company, and if you're saying that, okay, the only way you're going to grow now is your old customer base is going to just renew your phone, that's not a very, compelling argument. If you were going to tell me that, okay, you go into a new country, that new country, the middle class rises, it becomes more affluent, then they're going to buy a more luxury product like Apple. That's a story that I like better than that. Now, as far as the products are concerned, I mean, they're already a very expensive phone. It's not these are not cheap phones. And to say that the cost could go up by 30, 40, 50%, I mean, that's a very big number, frankly. That reduces people buying those phones in the developed market as well.
So have we seen any history from Apple about their ability, their willingness to raise prices when needed?
No, but I cannot remember to this extent. I mean, there has been a raising prices. They typically what they do is they give a base model with some memory and with, they for the higher end model with better camera and other things, it's a more expensive product, but the margins kind of remains the same. But, it'll be very tough for them to take $1,000 phone and say that, okay, now it's going to cost $1,500, $2,000 or even more in the marketplace.
Oh my God. I mean, I remember when the phone was under 1,000 and it was like going to be over, and it was like, no one's going to pay that. And you know what? They paid it. So right. There is that. All right, Anurag, always good to catch up. Anurag Rana, Bloomberg Intelligence, senior technology analyst, joining us on Apple. Okay, coming up, Derek Flakel is Bloomberg NEF lead U.S. policy analyst, and he's going to join us to discuss the impact of tariffs on the green transition.
Yes.
In light of the fact that we're going to get an executive order coming today at 3 p.m., which is
right.
going to try and boost coal and coal production in the U.S., green transition feels real off at that point.
Right, right.
So potentially we could see things like federal land being leased for a new coal plant. You could also wind up seeing coal being labeled a critical mineral, which would unlock money from D.C. to speed up production. And coal is a critical mineral is a definite head scratcher because everyone has a lot of coal, but that's a side note. Anyway, so we'll break down what that green transition winds up looking like, and a stock market that's still off the highs, but up by over 2%. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ all advancing on a rebound Tuesday. And this Bloomberg Business Flash is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor staff ratio. Small firm attentiveness, big advisor impact. Go to Commonwealth.com to learn about their consultative support and technology. S&P right now up 134 at 51.96. That's a gain of 2.6%. S&P have been up as much as 4%, so we're off session highs, but still advancing. The Dow up 1,009 now, up by 2.7%, and a 3% advance today for NASDAQ, up 468 points. NASDAQ 100 index doing a little bit better, up 3.1%, but the Russell 2000 lagging today, up by 1.8%. 10-year 4.20%, the 2-year 3.79%. Gold up $24 the ounce, now at $3,007. That's a gain of about 0.8%. And West Texas Intermediate crude down 0.1%, 60.61 a barrel. Small business optimism is down across the U.S. And with that story, here's Bloomberg's Vinny Del Giudice.
Small Business Optimism Index posted the largest drop in almost 3 years in March. U.S. tariffs are clouding the outlook. Inflation and a lack of qualified workers also remain concerns. The share of small business owners anticipating better conditions over the next 6 months posted the sharpest decline since 2020. The data are compiled by the National Federation of Independent Business. Vinny Del Giudice, Bloomberg Radio.
Eli Lilly shares higher after Goldman Sachs upgraded the obesity drug maker to buy from neutral. Lilly up now by 3.5%. HP Enterprise lower after being cut to equal weight from overweight at Morgan Stanley. HPE is trading a little change right now. As a matter of fact, looking at a reversal for Hewlett-Packard Enterprise up now by 0.4%. Stocks higher, rallying the most since 2022 on trade deal hopes. S&P up 2.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, thanks so much, Charlie Pellet. Alex Steele here alongside Paul Sweeney. Here's a headline for you. Hackers apparently have spied on 100 bank regulators' emails for over a year. Huh. Okay, so there you go.
We'll have
Take
more
that.
reporting on that.
Yeah, we'll bring you any more headlines on that as it crosses. All right, let's go now to the effect of President Trump's policy on, say, green energy transition. Today at 3 o'clock, he's supposed to sign some executive orders to push forward coal production here in the U.S. Want to go to David Flackel, Bloomberg NEF lead U.S. policy analyst. NEF is originally known as New Energy Finance, or the team within Bloomberg that tracks and analyzes the energy transition. What do you make of this executive order coming today at 3 o'clock on coal, and what does it mean for the broader transition?
Well, the executive order is interesting because this is sort of a replay of what Trump tried to do in his first term, right? He had previously talked about increasing payments to or using emergency powers for preserving existing coal plants, maybe bringing old ones back online. And as we can see from the power generation data, that didn't really work out. Coal is now 15% of generation in the U.S. Per year, down from considerably higher levels before. So there's a lot of different moving parts to this. You might see more, say, coal exports, more long-term gathering of coal leases, which have been sort of moving back and forth from Obama to Trump 1 to Biden and now to Trump 2. But in general, it's hard to say that this will be a huge boon to coal build-out or restoration, especially when you have tariffs weighing on any kind of big capital project.
All right, so talk about, the energy ecosystem. Where do we get stuff for the energy ecosystem, whether it's fossil fuels, clean energy? Where do we get the equipment, and is that something that's going to be impacted by these tariffs?
Oh, very heavily. Even for fossil fuels, which are often a very domestically extracted resource, there's reliance on steel, aluminum, specialized equipment that's imported, which is why you saw the Dallas Fed register such negative opinions about the tariffs coming in generally. More broadly, in terms of, say, solar equipment, that mostly comes from Southeast Asia because we've had batteries on, so we've had tariffs on China for a long time. Batteries themselves tend to come from China. Electric vehicles are imported from a variety of places, but especially, it's very domestic, but a fair amount of Canada and Mexico in there. And lastly, if you're thinking about say, offshore wind, that's pretty dependent on Europe. The only thing that's really effectively onshore and minimally dependent on trade is onshore wind in the U.S.
What is the future of offshore wind in the U.S.? I mean, if we're talking about ramping up coal and sort of there's zero love from the administration on offshore wind, have we seen sort of, I don't know, leases or any contracts be broken, or do you feel like companies that are still committed to the longer term world of offshore wind?
Well, I mean, what the offshore wind companies will tell you is this is a multi-year, long-term process of building that's beyond any one administration. We have seen one lease be canceled by the federal government for an ongoing project, but generally speaking, we haven't seen a lot more movement for things that have already been permitted and leased. Now, that's important because the federal government has a lot of leverage over that process. We're not seeing a lot more being added to the pipeline, but the real issue is going to come in the form of costs, inflation, and also potentially interest rates. We saw a major slowdown in offshore wind under Biden, which is a very supportive administration, simply because the cost of inputs went up, and as inflation went up, the Fed hiked rates. And wind is a very large capital-intensive project category and especially sensitive to those kinds of things. So if the tariffs lead to those broader impacts, we might see some fairly negative results for even the offshore wind projects that are already allowed to go forward.
Derek, I think even folks that are, that question the value of the economic value of tariffs in general, they kind of recognize that some of this strategically important stuff, maybe that we learned was strategically important from the pandemic when the trade, the cycles were all disrupted, the trade routes were disrupted. That makes some sense. Is it clean energy? Did they have a focus on bringing this stuff onshore as much as possible?
There's been a lot of discussion of that across multiple administrations. The Biden administration was in favor of that. The Trump administration is in favor of onshoring manufacturing generally and of energy security, independence, even dominance, as they like to say, generally. But that's a hard thing to achieve with tariffs alone. Ultimately, a lot of these solar factories, battery factories, EV factories that are coming up in the U.S. are dependent on imports, whether those are imports of upstream components or of the manufacturing equipment needed to make the final products, solar panels and batteries themselves. And right now, we're seeing costs go up on those across the board. Unless you have more reliable revenue streams, like tax credits, for example, it's kind of hard to imagine new decisions to build that stuff out. Even things that are already being built are facing uncertainty, not only from the Trump tariffs, from other investigations into tariffs being run at the Department of Commerce and U.S. Trade Representative, but also on the fate of those tax credits, which is going to help guarantee their revenues in the long term.
Yeah, it was a great point, which leads us to the IRA, the Inflation Reduction Act, which, I mean, clearly President Trump hates that thing, but there is a lot of value in it through the tax credits and subsidies for companies that supposedly he is a fan of, like the oil industry, for example. When do you think we're going to know the fate of the IRA and those tax credits?
That's a great question, and I've been wondering it myself. Obviously, we're seeing a lot of wrangling between the House and Senate today about the top lines on their big budget bill they're going to try and pass by the end of the year. Obviously, the end of the year is when individual tax rates go up, and so that's one of the big forcing functions. You also are seeing the X date, the debt ceiling, occurring somewhere between July and maybe September, and that's going to be a point where there's going to be a lot of pressure to pass a big budget package, raise the debt ceiling, and probably also get some of this tax material done. But we've seen a lot of deadlines blown already for when we were allegedly going to get top-line packages, which are a precondition to figure out what's going to happen to what tax credit. And we don't even know that yet. At this point, we don't even know if they're going to use this particular budget gimmick called current policy, which would really reduce the pressures to cut more. And as they're trying to use that, we're seeing a lot of blowback from fiscal conservatives in both the Senate, but especially in the House. And so we'll see.
All right, Derek, I think a lot of folks in the marketplace are saying, we'll see. We're not sure what's going to happen here. So,
how long can you put off a business decision with we'll see?
Yes, exactly. Derek Flakel, a lead U.S. policy analyst for BNEF, really a smart guy. So I was shocked to find that he went to the University of North Carolina. But every once in a while, somebody will pop out of that system and surprise you to the positive side. So, but I would think that these tariffs are going to be. It doesn't feel like any company can really escape the impact.
No.
I mean, because there's so many countries that are so broad-based, at least at this point.
And then it also just makes me wonder how the contracts are already set up with your suppliers, right? And who bears that commodity cost at the end of the day, and if it's going to be a solar company or a wind company, that's really rough. We saw that with offshore wind during COVID and that supply chain crunch, and that's basically what turned the tables against offshore wind economically. All right, coming up, Poonam Goyal, Bloomberg Intelligence on retail and tariffs. This is Bloomberg.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Welcome back. We have some breaking news for you. The Supreme Court backs President Trump for now in federal worker firing case. We will, of course, bring you any new updates as that headline crosses, but it looks like the Supreme Court is backing President Trump for now in federal worker firing case. All right, let's go back to tariffs and take a look at the broader market. When it comes to retail, as you mentioned earlier, Nike just cannot seem to win on that. They were in China, then they diversified, and now those diversified countries are also getting hit with tariffs. Poonam Goyal, senior U.S. e-commerce and retail analyst at Bloomberg Intelligence, joins us now. Poonam, do we have any idea how some of these retailers, how much these retailers will have to increase their cost to consumers to make up for tariffs? Any modeling done on that yet?
Yeah, we're working on the numbers, and it seems just back of the envelope math that you're looking at about a 10% increase. But that depends, right? Because we think if the tariffs stay as they've been proposed on April 2nd, then it's likely that these brands will go back to the suppliers to have them help them absorb some of these costs. So it really depends on what you're modeling, if you're assuming that half the costs would be shared or not. But I think in general, with the tariffs in place right now, you're looking at least a 10% reduction in prices to really offset this 50% increase roughly in COGS to the U.S.
So, I mean, they're gonna have to raise their price on the final product by 10%.
Potentially,
they might need to.
Okay,
yeah, it could be as high as 10%.
Okay. Are there is this kind of done at an industry level, Poonam, or is it company by company? Like, does Nike have more leverage over suppliers than, say, another company?
Yeah, I think Nike has the greatest scale of the athleisure company, so they definitely have more leverage than, for example, you would see at an Allbirds or some of the smaller footwear companies. But that said, you're talking about an average, a weighted average, 40% increase in tariffs. So it's a pretty sizable amount. That said, also think about the way Nike operates, right? Nike has a solid international arm. So when you look at their business, it's just the U.S. business that will be impacted. So when we look at the U.S. margins, there's going to be a sizable impact there. But when you put it all together against the total company, the impact does become less and it can be absorbed. That 10% is a global number that I gave you. If you want to just pair the cost exposure to U.S. only, it would be significantly higher to offset those costs.
Wow, that's something. I'm already getting emails in my inbox from when I'm subscribed to some retailers. Already by Saturday morning, they were like, we're going to increase our prices, etc. How much are we seeing of discounting now to get people still coming and inventory out their door now? Is that happening? Because it's happening in, say, Ford and Stellantis.
Yeah, I'd say, the discounting is happening as it should be happening, the regular cadence. I don't think retailers are adding more aggressive discounts to get the inventory out, to get more expensive inventory in the door. Nike, has a separate problem. They have had an inventory problem for some time now, and they are under the process of liquidating a lot of that unwanted inventory. So there are steep discounts happening at Nike. But for the companies that are bringing in new goods, I wouldn't expect them to discount significantly right now to get in the goods, especially if it's a staple product, right? One that doesn't change with the fashion or the weather cycle.
Right, that's fair.
What are we hearing from Amazon.com? What are they saying about it?
Good one.
So Amazon.com isn't saying anything yet. We'll see on earnings, but what are we saying is the question. Look, it's going to impact Amazon too. And really the impact comes more from the demand side. They are insulated when it comes to the retail side to some degree because they have 60% of their GMV coming from third-party sellers. But when these third-party sellers, who likely have much less scale than Amazon, they're going to be passing along those price increases. And that means that demand could fall off, and it probably will fall off. So Amazon's marketplace could see falling demand as a whole. And not only that, right, when you think about demand falling, the advertising business, which has been growing at a rapid clip, we're going to see brands pull back advertising because 90% of Amazon's advertising business still comes from retail media.
Okay, so given your coverage universe, what company is best positioned to either pass on the cost increases or absorb them?
I think the companies or the sector that's best positioned is the resale sector. So you're talking about companies like...
No, keep going.
The consumer, when they're pressured, they're going to shift to value. And these are the places you find value. So I think these companies are largely more insulated than the rest because they offer value. And the resale companies, especially, you know, if you're reselling something out of your wardrobe, you're not essentially paying the higher cost for it. So it's a great deal.
All right, Poonam, thank you so much for joining us. Poonam Goyal, Senior U.S. E-commerce and Retail Analyst, Bloomberg Intelligence, joining us from Princeton. So are you rushing out to shop?
Well, actually, no, but we're also trying to furnish this extension that we put on our house in Massachusetts. And I'm like, let's get this stuff now because it's going to be really tight. Like we need a light, we need a couch, like stuff like that where you bigger bulk items that you're not going to replace frequently. I'm like, oh, we got to move fast.
Right. Okay. Well, I think it is. So it is affecting people's behavior at this point.
Yeah, but in terms of like my discretionary spend, because that feels a little less discretionary, I'm definitely not even touching anything at this point.
Right.
Because it's too scary.
Right, and that's what I think. I like to walk by on the walk to Penn Station today. I'll walk by the Apple store on Fifth Avenue.
Oh, yeah, and?
See what, I'm going to do that on the way home. I'll see what's happening. I'll report back if I see anything of great interest.
There was reporting that there was kind of a rush to get in the store to buy the items now.
Yep.
We'll see how much legs that actually has.
John Tucker saying he's staying with his BlackBerry. He's not going to.
He's a BlackBerry? You're joking.
I don't know. That's what he says.
He's a flip phone.
He
Come
has
on
a
now,
flip phone.
people.
Exactly.
All right, that wraps it up for me and Paul on this Tuesday, on this dead cat bounce day. Can I say that, or is that too pessimistic? All right. Well, we are seeing the S&P still up by over 2%. Coming up next, you have Balance of Power with